movie.
Grab your phone.
Fight for that toy.
Yeah, I do. But is that you're sort of reminiscing over that?
No, I'm just probably going to watch that this weekend. Put that on the list of Christmas movies to catch up on. Okay, let's move on. Up next on the programme, we'll catch up with Seema Shah of Principal Asset Management. We'll speak to Ed Mills of Raymond James, Wendy Stewart of Bank of America, Michael Kushner of Morgan Stanley. Equities pulling back from all-time highs, just a touch. We're down about 1/10%.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
What legacy I would love to.
My name is Konstantin Stefana. I am the owner of the AF Family Office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so anybody, we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week from morning to night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Moderation in U.S. growth next year, but not radically.
The problem is we're on a knife's edge when it comes to wage growth versus inflation.
The next 6 to 12 months is going to be really critical. This economy is still wobbly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures slightly softer. We're down 1/10% on the S&P. Similar move on the Nasdaq, down by about 1/10. Contrast that. Compare it with November, up 5% on the S&P, up 5% on the Nasdaq 100, on a Russell up by double digits, climbing by almost 11%. The next stop for this market, payrolls on Friday. The estimate in our survey so far, around 200K. Just how high is the bar for this Federal Reserve to hit pause?
And right now it seems like the bar is getting higher. We will find out because we will be hearing from a host of Fed speakers this week, including Fed Chair Jay Powell, who's going to make a surprise appearance in a moderating conversation at a conference on Wednesday. A key question here will be, how much are they going to signal that they are going to cut rates, but that is going to be the last time? Are they going to set the groundwork for cut now, pause later?
So the conversation has evolved, and clearly the data has come in stronger than they thought a couple of months ago. In August, in that Jackson Hole speech, you felt like they were setting you up for the beginning of a deep rate-cutting cycle to protect the labour market, get back to neutral, and get back to neutral quickly. That story's changed. That story's changed because of the incoming data. How much does this story need to change because of the policy changes we're now anticipating for 2025? And can he really confront that story in a big way in the coming weeks?
A lot of people are arguing, postulating that they're not going to probably address it at the meeting in a couple of weeks' time. That said, that early next year, you're going to have to start considering it. Right now, we're just getting sort of proclamations and truths from the White House South. But there is this question going forward about how that really does increase not just potential inflationary pressures, but also what we're hearing from a lot of CEOs, executives who are saying, well, maybe we're going to have to raise prices here, or maybe we're not going to be as aggressive here. So, you know, measuring sentiment might be as important as measuring what policies actually get into effect.
Have you noticed that nobody on Wall Street wants to be bearish going into 2025? You see this across the board, note after note. Looking ahead to next year, Evercore's Julian Emanuel valuations alone do not end bull markets. Signs of a top haven't appeared. Jonathan Krinsky over at BTIG, the path of least resistance remains higher. Even though lots of different things look extended, Cameron Dawson, New Edge with us about an hour ago, expecting this trend to continue.
Yeah, unless the earnings don't deliver. The earnings so far have been delivering, and we're at the end of the earnings season, so we're between that. And Decembers tend to be a good time. How many people want to bet against a president-elect who essentially is looking to markets to ratify his upcoming presidency and to ratify some of his plans? And that is the reason why people have taken a signal from Scott Bessent, maybe too much so, and that is an argument out there, that essentially the market will act as a check on Donald Trump. Of course, as we did hear from Cameron Dawson, there's a question about whether we're creating a narrative. I know, everyone's shocked. Creating a narrative around something that isn't actually moving markets. And it is fundamental data that is actually driving it.
You said this last week, and I think this is really important. You brought up a note from George Saravelos over at Deutsche Bank. The market's not responding to these tariff threats. And so long as the market doesn't respond, it just leaves the door open to make even bigger threats further down the road, and even bigger threats after that.
Yeah, we're less than 4 weeks away from the election. And you have to imagine that George Saravelos is onto something maybe early next year. And that's what everyone was saying, is that maybe this is a story for 2025, less so now, when it's more a matter of signaling of priorities and signaling of threats rather than actually being in the office and wielding the ability to latch tariffs onto certain industries. And that, I think, is the reason why people aren't taking it seriously now. Why worry now when you could just play and get returns?
And keep buying stocks, apparently. Stocks, by the way, just a little bit lower this morning, down by about 0.1% on the S&P 500, following the biggest month of gains on the S&P of the year so far. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management with stocks at record highs, Ed Mills of Raymond James as Canada and Mexico respond to Trump's tariff threats, and Wendy Stewart of Bank of America on the outlook for commercial banking. We begin this hour with stocks at all-time highs, investors looking ahead to payrolls, to CPI, and the last Fed decision of the year. Seema Shah of Principal Asset Management saying come early 2025, rather than reducing policy rates at each meeting, the Fed is likely to slow its cutting pace to every other meeting, with some risk that rates don't fall as far as either the Fed or the market had originally envisioned. Seema joins us now for more. Seema, welcome back, and it's good to see you as always. How problematic do you expect that to be to equities?
Well, actually, I don't know if it's going to be that problematic for equities. I think the key thing that equities need is the strong growth and almost a Fed put. So where it becomes really challenging, though, is if inflation starts to become a little bit more concerning, and then the Fed doesn't cut rates as far because they're worried about inflation expectations increasing. That, I think, would be the fly in the ointment for equities. But otherwise, I'm going to add to the masses. I'm pretty positive about next year.
Really positive about next year for the US and Europe, or just the US? Because all I've heard is the US, and Europe's kind of been left in the dust.
Yeah, I think the story for Europe has got even worse in the last couple of weeks. US exceptionalism was the story for this year. It's going to be the story for next year, even more so now that we've got the election behind us. And Europe, it was already struggling with weak fundamentals. The economy is already struggling. We've already seen evidence that now services has joined manufacturing in that cooling period. So I think it's a challenging period for Europe, and certainly for us, it's more about US equities in Europe. I think there are opportunities in other parts of the world, some segments in Asia, various pockets. But overall, I think this is going to be another year where you see continued strength for the US.
Seema, can you quantify how much you're sort of doubling down on this bet that the United States is going to be the bright spot and that Europe is going to be even worse than it was this year?
I think for Europe, I think the thing that we're trying to watch as well is we have to keep an eye on those technicals. Where is sentiment? We do think that sentiment is getting incredibly negative about Europe. As you've just said, everyone is joining in to that massive US over Europe and becoming very, very negative on that side. Valuations are looking fairly attractive for Europe. So it could be that you just need a slight improvement in the outlook for Europe, some kind of upside surprises with regards to the economy, maybe the ECB really stepping in and starting to improve investor expectations. And that could be enough to shift that needle. But certainly at this stage, it's quite difficult to see that coming through.
There's a question, Seema, about whether you can bet at least on European bonds at the same time that you bet on American exceptionalism, because you can imagine the ECB is going to have to cut rates more aggressively. And if there is some sort of downturn, that could be some sort of haven trade. Do you believe that that is the correct way to go? Or do you think that that is premature at a time where the bond vigilantes seem to be having their pens and papers out for the likes of France?
Well, I think as it is always the case with Europe, you can't just look at Europe as a one entity. There's so many different entities which are very different, disparate that in that region. Overall, yes, the ECB is going to be cutting rates far more aggressively than the US. I think there could be a 50 basis point cut thrown in there at some point in 2025. And they're going to be reducing rates below neutral, whereas the Fed is going to get maybe a little bit close to neutral, but probably not below. So there is reason to have that overweight to European sovereigns rather than the US. But as you said, you have to be really careful, and keeping an eye on what is going on with the budget deficits in every country that we're looking at, I think is going to be a key theme for next year. Because, we talk about Fed policy uncertainty all the time, but there's so much on the government policy side with, as you said, bond vigilantes really starting to gear up and keep an eye on what's going on in different countries. We've already seen it in the UK. We've seen some idea of it within the US, and clearly is coming through in France as well. So I think that is going to be a key conversation for all the countries for next year.
Which raises a question, Seema, about whether the correct trade on American exceptionalism is with the small caps, given the fact that they seem most leveraged to the potential of bond vigilantes just peeking out the window in the United States. Even that alone would be enough to potentially dent some of the valuations.
Well, look, I think for small cap, the run it's had so far is really about valuations. It's still due for that catch-up try, so it's catching up with the large cap and it's got attractive valuations. But as you were saying before, small caps, small businesses, they have a really significant exposure to floating rate debt. So if you're not going to see very significant rate cuts coming through next year, maybe because of increased inflation concerns, then that's going to be a fly in the ointment for small caps. So I think that you can run through for a little bit longer for small caps, but once valuations start to look a little bit less attractive, and certainly from a relative standpoint where large cap does continue to look more attractive, then I think the small cap agenda starts to really become a little bit more unattractive.
New question for the office quiz over the Christmas holiday period. Do you want the new question?
Yeah, please.
What's the DAX done in 2024? I'm not going to put you on the spot and make you answer that. Seema Shah, the DAX so far this year is up by more than 18%. And as we speak about how bad Europe is, the DAX is at all-time highs. Seema, it begs the question, what is the DAX doing at record highs if things are so bad in Europe and things aren't great in China either?
It's a great question. And I think this is a key thing for investors to remember, is that, look, from a relative standpoint, yes, there's going to be big differences and these are going to look more attractive. But if the US market is doing well, it does tend to carry most markets with it. So there will be opportunities globally. And I think when we're going into 2025 with so much uncertainty from a policy perspective, especially now with the new Trump administration coming in, it does make sense to have that global diversification. Our preference is still for Europe, but we do think that there's opportunities outside of the US as well. So you do get to have some diversification, some exposure to different markets too.
It's the banks, Bramo. Commerzbank, Deutsche Bank, year to date performed really well.
Yeah, and how much is this a catch-up trade? How much is this because there is this bet on rate cuts? And how much is it because the likes of Deutsche Bank have expanded dramatically outside of Europe? So it sort of goes to Seema's point that if they have some sort of footprint outside of Europe, they can benefit even if they're listed on the DAX.
Seema, it's good to hear from you. Seema Shah there of Principal Asset Management on the path forward into 2025. The takeaway from Seema is just how little needs to go right to really trigger some of these squeezes in some of these European assets.
Yeah, although it's a pretty high bar for a little to go right, considering that we've continued to be disappointed. I was looking, you talk about the DAX, take a look at the CAC over in Paris. And
down about 5%.
Yeah, it's underperformed the broader European stock market by the most going back to 2010. So talk about the splintering of some of the traditional behemoths in terms of economic heft of the European region. It becomes a little bit dicey to understand what the correlations are based on history because they're kind of breaking down.
France has been really weak. As we speak, equity futures recovering just about unchanged on the S&P with an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Syrian rebel fighters are advancing southward after capturing much of Aleppo. It's the most serious challenge to President Bashar al-Assad in years amid the country's civil war, which began after an uprising in 2011. The rapid assault is being led by an Islamist rebel group based in northwestern Syria's Idlib province. Government forces, which are supported by Russia and Iran, have appeared to withdraw from some areas. Tesla and BYD are offering discounts and incentives in China to meet annual sales targets. That includes a 0% loan and cash discounts on certain models. On a post to its Weibo account, Tesla said that it's offering 5-year 0% loans and a 10,000 yuan discount on its Model Y SUV until the end of the month. BYD is on track to exceed its annual sales goal of 4 million cars, but its smaller rivals have already met their targets. And a major snowstorm blanketed parts of New York, Pennsylvania, and Michigan over the holiday weekend. Forecasters expected very cold temperatures and heavy snow to persist throughout the beginning of this week. The storm led to an emergency declaration in parts of New York and a disaster declaration in Pennsylvania, and officials warning of dangerous conditions for Thanksgiving travelers returning home. That's your brief. John.
Danny, thank you. So our holiday quiz is coming together. Name 5 companies on the Russell. Question 1. Okay. What's the DAX done year to date? Question 2. I think we need about 8 more questions. Okay. 10 questions to make this work, right?
Yeah, I'm trying to think what they could potentially be. Which New York State county got the most snow over the past 4 days?
You know the answer to that, don't you?
Barnes County.
Okay. How deep?
It was 45 inches of snow so far.
Wow.
Yeah, if you take a look at some of the totals, it's like 4 feet that are expected in Watertown, I think, New York. So I don't think that's going to make it on the quiz. Don't worry. Stop doing research on that one.
That's incredible. Futures right now on the S&P just about recovering, almost unchanged. Up next on the program, Canada and Mexico preparing for President Trump.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico, we have got to get our border security in the United States squared away.
That conversation up next.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The path to year end looks like this. Friday, payrolls. Next week on the 11th, CPI. December 18th, the Federal Reserve, then go home. Year over. At least we hope. Equity futures on the S&P right now, down by almost 0.1%. Check out the bond market. Yield starting the week just a little bit higher, up 4 basis points. The 10-year, 420.91. Under surveillance this morning, Canada and Mexico preparing for President Trump.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico, we have got to get our border security in the United States squared away. And then secondarily, I think he's very concerned about imports from other countries that are going to try to take advantage of the USMCA. He's also using it as a lever to get serious conversations in Ottawa and Mexico City with Washington.
So here's the latest on that front. Fresh off a visit to Mar-a-Lago, Canadian Prime Minister Justin Trudeau promising to increase border enforcement to try and avoid tariffs. Mexican President Claudia Sheinbaum also saying she's confident she can reach a deal with President Trump. Ed Mills of Raymond James joins us now for more. Ed Mills, what does that deal actually look like?
Well, I think, John, it's a question, do we pull forward some of that renegotiation of the USMCA, which is due to be renegotiated in 2026? I think it is clear that there's going to have to be significant increases in border-related items. We see that Donald Trump is going to lead off after he's inaugurated with a number of immigration-related issues. I do think as it relates to both Canada and Mexico, a lot of changes to the way in which tariffs are done on autos, and probably a huge push towards protecting the U.S. auto industry, especially vis-a-vis China. And I think what it really comes down to, especially as it relates to Mexico, is that U.S. tariff policy, John, states that you put a tariff on where a product is finished. China knows that. China is moving a lot of production into Mexico and then is able to bring things into the United States tariff-free. That's known as the Mexico backdoor. Donald Trump is going to want to make sure that Mexico backdoor is fully closed.
Ed, there is a lot of people that are listening to what you say. They heard from the president in the last week, and they just believe that the tariffs that he's threatening aren't credible threats because he won't follow through on them. Peter Chia of Academy wrote over the weekend, consensus is right now that this is just a bargaining chip. Bring them to the table. They've come to the table and maybe get a little bit of something out from them. They don't think he's going to follow through. Do your clients see it quite the same way, Ed?
John, I think that's probably right. I was kind of going through this yesterday thinking that when I wrote the note last week about the tweet on the 25% tariffs that could be coming, there wasn't the same market reaction that we saw back 2017 to 2021 during Trump 1.0. I think that there is a long list of tariffs that were proposed against Mexico in particular during his first term that never were followed through. So right now, I think that the market would be surprised to the extent that these go into effect. The thing that I am watching, especially as it relates to Mexico, is that I think there's a personality clash between Donald Trump and Mexican President Claudia Sheinbaum ready to happen. And I think that is probably the wild card to watch. She's going to be much more forceful in protecting Mexico, and Donald Trump is going to be also much more forceful on immigration in his second term than he was in his first term. And as that personality clash pays out, I think there's a higher probability for some of these tariffs to go into place, at least temporarily. He's talked about using some dormant authorities that the president has not been using in the past that can put on temporarily tariffs up to 15% without Congress, without an investigation on day one if he wants to do it.
Ed, can you take that a step further in terms of what we've learned from some of the recent conversations, or at least the readouts and the contradictory readouts from Mexican head Claudia Sheinbaum and Donald Trump, as well as the recent meeting with Canadian Prime Minister Justin Trudeau? How much is this just Donald Trump testing different leaders' abilities and willingness to come kiss the ring versus actual policy prescription at this point before he even enters the White House?
No, Lisa, I think you are right. I do think that this is a testing the waters phase of this. I do think that the readouts have to be taken with a grain of salt. Donald Trump is not using kind of the traditional ways in which we deal with diplomacy, not getting the State Department involved. We all know that. So kind of each president is able to put out their own kind of message as it relates to Donald Trump or Claudia Sheinbaum. Justin Trudeau, as prime minister, is able to put out whatever he thinks that is necessary. But I don't necessarily think that this is something that you test it out, get some changes, declare victory, and move on. The issues that he's talking about, and then you put into place some of the personnel picks. Howard Lutnick at Commerce, going to be very aggressive on tariffs. Jamison Greer, who is going to be the pick for U.S. Trade Representative. One of the reasons Donald Trump picked him is he's going to be much more willing to be more aggressive with some of those authorities that I've discussed than Bob Lighthizer. So I understand the reluctance to over-index or over-expect that this is going to happen on day one. But tariffs are coming. It is going to be volatile, and we have to expect the unexpected when we think about Trump 2.0 for this market.
And how many of these nominees are actually going to get through at a time where we have a lot of clashes between already John Thune, who's the head of the Senate leadership for Republicans, and at least one or two of these candidates?
Yeah, so I was looking at the ones that you've put up on your screen. I think most, if not all, of the picks for Treasury Secretary, U.S. Trade Representative, Howard Lutnick, more likely than not to get confirmed. FBI Director, a big question mark. The Defense Secretary, big question mark. Health and Human Services, an area at Raymond James that we've been getting a lot of more of a question mark, but probably in that toss-up category. So Donald Trump with 53 votes in the Senate, and it only takes 50 to get the nominee confirmed. Far more than would normally get confirmed if we had the old 60-vote majority that was required in the Senate get confirmed. Donald Trump will have a cabinet that he wants. There will be some exceptions, but for the most part, I've been telling clients, expect the vast majority of these nominees to be sitting in their post sooner rather than later, Lisa.
Meanwhile, Ed, we do still have a sitting president. He occasionally tries to remind us of that, the latest coming out with some new restrictions on Chinese semiconductors, in particular having to do with AI memory and tools to build the high-end chips. How do you interpret this, basically, some of the actions that we're seeing out of the White House now at a time where a lot of people have almost discounted current President Joe Biden?
So as it relates to tech restrictions, Lisa, I've been telling clients at Raymond James, this is bipartisan. This is something that the Biden administration picked up the torch from Trump 1.0 and accelerated that during his term. We will get these restrictions out during the Biden term, but they probably go even further during the Trump term. The restrictions that we're discussing this morning are restrictions that have been in the hopper for months. The Biden administration has been working with the Netherlands and Japan trying to get a trilateral deal. There are some differences in the way in which the United States, the Dutch, and the Japanese enforce these tech restrictions. That is an unfair issue for U.S. companies. The expansion is about making sure that China doesn't engage in what has been a game of whack-a-mole, where as soon as we put on restrictions, they either move production to a new country or they establish new companies that are not on restricted lists. I am anticipating that the Biden administration tries to tighten up that game of whack-a-mole. The big question to me for clients is, how much of a hammer does Donald Trump come after that next year and tries to end that game of whack-a-mole and has much more restrictive changes to semi-cap equipment going into China, especially on legacy equipment during his second term?
It's a big question for all of us going into 2025. Ed Mills of Raymond James. Ed, thank you, sir. Just check out the picture of Donald Trump, President-elect's economic team. And let's go through the names, and we'll talk about the name that's not there. Hassett at NEC, Jamison Greer, U.S. Trade Representative, Scott Bessent at Treasury, Howard Lutnick at Commerce. The market was very worried at one point about Ambassador Lighthizer going into the cabinet again, but maybe becoming Treasury Secretary, maybe ending up at NEC. The reporting from Axios over the weekend, almost reinforced by Ed Mills there from Raymond James, that the people that have been selected are going to be even more hawkish than Ambassador Lighthizer would have been. Axios essentially reporting that over the weekend, that Lighthizer wasn't selected because he wasn't going to go big enough on tariffs. I'm not sure what that should tell you about how far they're willing to go.
There have been a number of signs that President-elect Donald Trump isn't happy with the market, viewing some of his tariff threats as simply that and not actually having meat behind them. And it seems like that is going to be a continued theme.
A conversation, and that theme's going to be the theme potentially of 2025. On that, Wendy Stewart at Bank of America, up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equity futures recovering here. We're just about unchanged on the S&P 500, moving into positive territory on the Nasdaq 100, on the Russell, after a stellar month of gains for the month of November. The Russell up by close to 11% through last month. The small caps this morning outperforming. We're up 0.25%. With 2 hours until the cash open, with some morning movers, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Stellantis, let's kick off there. This is the ADRs. We've done a full vault face from the management at Stellantis. They've gone from unanimous support for Carlos Tavares staying until 2026 to leaving with immediate effect. He is, as Oliver Crook in Germany said, he is the PE master of the auto industry, cutting. But did he have a big enough plan to take this company forward? We know that this is Michigan calling Turin. We have a problem. Rapid degradation of Jeep, Ram, Chrysler, and Dodge. Reckless short-term decision-making. That was back in the autumn. That was the message from Michigan to Turin. We're here too. And their sales in the United States of America have absolutely drifted down, not crashed. We've gone from the second quarter of about 11.7% market share here, all the way down, John, to just under 10%. So this is a dissipation of positioning, and what do you do to turn it around? Have a look at NVIDIA. I think there's a couple of things going on with NVIDIA this morning, down by 0.4%. More curbs from the Biden administration, but that's not going to really wrought much damage for NVIDIA. Under the hood, Bridgewater sold 1.8 million shares at the end of the third quarter. You never really know the rationale or the reasoning for these moves, but they lumped up on Supermicro, so it's just a little bit of a kicker in the NVIDIA story this morning. Gap, we spent a lot of time talking about the retailers last week. The stock is up just under 5% this morning. On earnings day, it was down 9%. Dana Talsey was sitting with you, and she said innovation is the key. Well, JP Morgan sat down with the management, Richard Dickinson, and the CFO, Katrina O'Connell, and they talk about a consistency of the playbook. They have got the recipe right. It's now about execution. Jonathan, good morning.
Manus Cranny, good morning to you, sir. We'll see you again in about 60 minutes' time. I want to turn to France just quickly. Check out the euro, French 10-year, and a French equity market as well. The equity market recovering in the last few moments. The CAC 40 now positive on the session by 0.2%. At session lows, we were down by more than 1 full percentage point. Just some headlines crossing in the last few minutes, Lisa. Maybe some concessions for Marine Le Pen.
It seems as if Marine Le Pen's argument that don't take away the stuff that people really like just in the name of budget fiscal prudence has gained some traction. This saying that basically the government will not drop drug reimbursement in its 2025 budget. Basically, they were going to revoke some of the reimbursements that they give out for drug expenses. They aren't going to do that anymore. Again, this is sort of edifying this feeling that the government will not necessarily disband, that France isn't going to be in a political crisis in the near term as a result of basically kowtowing to some of the demands coming from the far right.
Supporting French assets just for now. We'll keep an eye on that story for you. Under surveillance this morning, a top story over the weekend. Stellantis CEO Carlos Tavares stepping down following a board dispute over weakening sales and a stock slump. Sources telling us here at Bloomberg a new CEO will be named in the first half of 2025. Ollie Crook did a great job of covering this story out of Berlin for us a little bit earlier on this morning. Clearly, the path forward is a troubled one, and right now, there's no one steering the ship.
Real question of what they plan to do to turn things around. Will it be a fire sale of inventories? Had some cold water poured on that from Tom Narayan, and they don't really want to do that if they can help it. There's a real question about a spin-off of potential brands or closure of others. It seems like universally, whether it's dealerships, whether it's actually the workers on the line, everyone seems happy that there's some sort of change based on the commentary. So question now is, how do they turn the ship around at a time that's very difficult for the auto industry?
We spoke to Carlos a number of weeks ago. He was always generous with his time. He really laid out the challenge for European automakers into year end. He wanted to ultimately to see a plan from European officials to incentivize the purchase of some of these EVs, which were lagging across the continent, or ultimately we'd have to cut capacity. That's not going to win you any friends with the workforce. Didn't win many friends with the dealerships. We saw those complaints because there weren't enough investment, wasn't enough investment. Their complaints were things like there weren't enough models to sell, new models. There were the problems there. I want to understand where the tension was between John Alcan, the chairman of the company, heir apparent to the Agnelli family over the last few years. The tension between him and Carlos Tavares. What did Carlos want to do that Alcan was upset with?
Did he want to spin something off or close a specific brand? We will be looking for the write-up, the play-by-play about what actually happened over the weekend. In the meantime, a real question of why Carlos Tavares wasn't the fall guy, why he didn't make all of the hard, bad decisions and then leave. I mean, ultimately, there was sort of a question, don't you want to clean house? And if you're already unpopular, well, it's carte blanche to go do all of the unpopular things that people are saying might be necessary to revive the brand.
Still waiting for that kitchen sick moment for the European automakers. Canada says it will step up border enforcement in a, quote, visible and muscular way as it looks to avoid tariffs under a new Trump administration. The Prime Minister Justin Trudeau met with President-elect Donald Trump at Mar-a-Lago on Friday.
What do you think that conversation was like? We're not the problem. Why are you picking on us?
They looked happy around the table.
Yeah.
I've got no idea what the conversation was like behind closed doors. I imagine it was slightly different.
You know, play along, just make me look good. I'll have a win here. Look, ultimately, Canada needs the U.S. just as much as the U.S. needs Canada. And nobody seems to be taking, as you've pointed out many times, some of the threats for tariffs seriously, particularly with Canada and Mexico. If there truly were some sort of massive 25% tariffs, but particularly with Mexico, that would torpedo the entire auto manufacturing industry in the United States. So let's see what actually happens, and it's the reason why people aren't really taking it seriously.
I want to be very clear about what we're saying here. They aren't taking it seriously. We're not making a judgment about whether they should, because that's a very different conversation going into 2025. Maybe they should be taking it seriously.
Especially if the Axios reporting is correct, that Robert Lighthizer wasn't selected not because he would be too extreme on tariffs, but because he wouldn't go far enough. And that's a real question here. How much is this going to be raising the ante, especially if the market doesn't take this more seriously?
The Biden administration is making its own moves, restricting exports to 140 Chinese companies in the latest effort to rattle China's chip industry. Reuters reporting restrictions will also be placed on Huawei's chip-making partner, Semiconductor Manufacturing International. That's another issue this sector's going to have to deal with into 2025. Big issue for commercial banking as well. Wendy Stewart of Bank of America saying next year will be a year of change and uncertainty. Certain sectors and industries will benefit, others may not. I'm pleased to say that Wendy joins us now for more. Wendy, welcome to the program. I'm just thinking of the long list of things that your clients have to confront in the next 12 months. Taxes, tariffs, the prospect of interest rates not coming down as fast as maybe we thought they would only 2 months ago. What's the number one issue in the conversations you have at the moment, Wendy?
Good morning, Jonathan, and thank you for having me. So, when you think about our clients in global commercial banking at Bank of America, we work with over 15,000 middle market companies that are based in the U.S. and Canada, and they also do business around the world, and we cover their international subsidiaries. And these clients are publicly traded companies. They're also privately held companies, and we're continuing to see the generation transfer from the second to the third and the third to the fourth gen. And so, when you think about all of the things that they're faced, there is a lot of uncertainty as we go into 2025. And you mentioned a lot of the things that are top of mind for them: increasing considerations around tariffs, taxes, interest rates, inflation, and then also just the geopolitical tensions that we've seen. And, let me give you an example. We have a lot of clients over the last 18 to 24 months that have looked at what is happening geopolitically. They do a lot of business in Asia, and as they've looked at their China Plus One strategy, they have moved some of that business into Asia. And also, they've also moved that into other parts of North America, specifically into Mexico. And you all have been talking a lot about tariffs and what will that mean for clients. And we've got a lot of question around that still. But I can tell you one of the things they're focused on in Mexico right now is the deflationary environment with the peso. And so we've been working with our clients to help them with that. And I do think that while we see a lot of uncertainty, we are looking at how we turn that into opportunity.
Wendy, let's talk about that a little bit more. Are they in a position to play offense, or are you finding them holding back on making big investment decisions, big CapEx decisions, until they've got the clarity on policy into next year?
I would say they're not making big investments, but they are making targeted investments. And so, we have seen a lot of good opportunity for our clients, especially, when you think about investment banking. And these aren't necessarily some of the M&A that would hit, the headlines very broadly, but clients are looking at opportunity to make those targeted investments. And I'll give you an example. We have a client that's based in the southeastern United States, privately held company, and this company did not have an exit strategy. They wanted to take some liquidity off the table, and they were looking at that liquidity event. And so in the meantime, we had another client that is based in Europe. That company did not have any U.S. exposure. And so these two companies, we introduced them, and it was a great fit. It enabled the Southeastern company to have that liquidity event they were looking for while also retaining a minority stake in the company. It then allowed the European-based company to have that U.S. exposure that they wanted, and we were able to leverage our international expertise to help with that specific transaction.
Wendy, this really raises a fascinating question, which is how much are you seeing a rush of foreign companies looking to partner with a U.S. company to get ahead of any potential tariffs or any potential actions from President-elect Donald Trump?
We are seeing that. And, I don't know that I would call it a rush. I think we've had ongoing interest all year. as companies around the world are looking at how they can diversify into the United States. The middle market client base that we cover is very attractive to them, and we are in a great position to help make those introductions and to see, you know, where those fits would make a lot of sense, and we will continue to do that.
Is there a level at which borrowing costs become prohibitive for some of these companies to expand in the U.S., especially if they're smaller? And we're asking this question as small caps outperform at a time that yields are historically relatively high, at least based in the past 10 years. Is that a concern, or is that not even on the table?
It's not on the table. You know, when we were looking at the interest rate environment in the U.S., you know, we were expecting that to continue to come down later this year and into next year. And for companies that are outside of the U.S. and might look at exposure into the U.S., you know, there is the ability to manage that interest rate exposure globally, and you know, they can certainly take advantage of borrowing in different currencies depending on what their needs are.
Do you get the sense, Wendy, going forward, that there has been certainty for some of these smaller companies in different regions to expand, to hire, to make some of the decisions that we heard were stymied by some of the political uncertainty prior to the election?
Absolutely. I mean, when we look at our clients, I would say the sentiment's interesting right now. There is a lot of optimism, and I think there is some pent-up demand. You know, clients, I think, have been a bit surprised that the economic environment has been more stable than they were expecting. That, combined with interest rates coming down and that demand, is creating opportunity. You know, and we continue to work with our clients not only as they focus on the geopolitical tensions, what that means for them internationally, but also here domestically. And, you know, we are continuing to do a lot with clients with the core banking needs that they have, whether it's loans, deposits, really helping them to manage their cash management process. And, you know, we have a new client that we've started working with that's based in the Midwestern United States. And this company is also doing business in Canada. They have exposure in two geographies outside of North America in two different regions. And when they looked at that entire cash management ecosystem that they had to manage, they were doing it on a very manual basis. They didn't have a lot of visibility. They had FX risk that they wanted to take off the table. And so we helped them with our Cash Pro system to put a solution in place. It is the platform into the bank that is both online and mobile, and it's enabled them to really manage all of this exposure and continuing to grow in a way that is safe, secure, and very efficient.
Wendy, you've given us some really specific examples, and I was just noting down some of the themes: managing the supply chain in Asia, managing the FX exposure, particularly down in Mexico, getting a presence to the United States, working that out too. Wendy, what I hear here is the need to be with a bigger player. And that's what we saw coming out of the regional banking crisis as well. Customers were looking to the Bank of Americas of this world. Wendy, is that still the same now? Have you held on to those clients? Are you seeing more clients come towards you ahead of 25?
We are, and in fact, 2024 has been a great year for us. It's our second strongest year in terms of client acquisition on record, and we expect that to continue into 2025, and it's for all the reasons you've just cited. You know, our client base is more global now than ever, and they absolutely need a partner who can help them navigate a lot of this uncertainty and turn that into opportunity for them to help them grow.
Wendy, this was brilliant. A belated happy Thanksgiving to you and to your family too. Thanks for being with us. Wendy Stewart there of Bank of America. Really specific. I think really offered a really good look at what's happening now with corporate America, and I would say arguably corporate America and beyond for the whole world, over three big issues: supply chains, FX exposure, and you need a presence in America right now. Selling into the United States is not enough. You need to be in the United States.
Which is a reason why those sort of cross-border investments are going so strong. You raised the question, how much does this really advantage some of the larger players to the disadvantage of some of the regionals that haven't yet clawed back? Do they have a permanent structural disadvantage because of some of these types of trends?
Imagine being exposed to the peso after the month we've just had. Some of those moves are vicious.
Dramatic, yeah.
Oh, huge problems potentially. That's the latest story on the banking front. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President-elect Trump is bringing someone that he pardoned into his administration. He's nominated Charles Kushner as U.S. ambassador to France, praising him as a tremendous business leader, philanthropist, and deal maker. Kushner is the father of Jared Kushner, Trump's son-in-law and former senior advisor. He served 2 years in prison for filing false tax returns, witness retaliation, and making false statements to the FTC. Volkswagen workers in Germany have begun their temporary walkout, hoping to pressure management during deadlocked negotiations over cost-cutting measures. The union opposes management's plan to close 3 German factories and lay off thousands of workers. A 4th round of negotiations is set to take place 1 week from today on December 9th. And it is Cyber Monday, and consumers are looking for deals online. Adobe Analytics, which tracks online shopping, expects consumers to spend a record $13.2 billion today. That's 6.1% more than last year. That would make it the season's and the year's biggest shopping day for e-commerce. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, bond vigilantes thriving in Europe.
The French government doesn't take ultimatums. It's looking at the French parliamentary debate. It's respecting each and every parliamentary debate that leads to an evolution. We will take into account what is changing, but we won't be blackmailed. We are committed to reduce the deficit.
We'll get you the latest on a last-minute concession to Marine Le Pen in just a moment from New York. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Stocks are doing okay here, coming off a month of gains that's delivered gains of more than 5% on the S&P and on the Nasdaq. We're just about unchanged on the S&P, so no drama here. Bond yields a little bit higher, off-session highs. We're up 3 basis points on a 10-year, 419.75. And the surveillance this morning, bond vigilantes thriving in Europe.
The French government doesn't take ultimatums. It's looking at the French parliamentary debate. It's respecting each and every parliamentary debate that leads to an evolution. We will take into account what is changing, but we won't be blackmailed. We are committed to reduce the deficit. The government is a government of dialogue, of respect, of co-construction. This budget has been co-construction. It's not the result of just a government project.
So here's the latest. The French government offering a final hour concession to Marine Le Pen's party on the 2025 budget, seeking to avoid being ousted from power in a no-confidence vote. The political uncertainty recently sending French borrowing costs to the highest levels relative to Germany since the Eurozone debt crisis. Joining us now to discuss is Michael Kushmer of Morgan Stanley. Michael, good morning to you.
Morning.
Giant step back. Lisa's talked about this for a while, and I think she's right to pick up on it. Bond vigilantes are back, and they're thriving in Europe. We saw it in the UK, we're starting to see it in France as well. Maybe Prime Minister Barnier can hold on. I've got no idea. But to Lisa's point, they're not going to be blackmailed, Lisa, but it sounds like they just were.
100%. Essentially, we're not going to be blackmailed, yet here you have it, and our deficit's going to be a little bit bigger for a while.
What do you think is behind this more assertive bond market, particularly in Europe?
I think it's the fracturing of political consensus to what to do with the challenges that are being faced, and putting a burden on fiscal policy when many countries have very little fiscal space to actually deal with this, with increased spending, cutting taxes, things like that. So how do you deal when you're getting pressure from all sorts of directions, and you know one policy mix will fix the problems you're facing?
As an investor, how much does that make you stay away from places like the French bond market, simply because if they do cut their budget, their economy tanks and they have no government? If they don't cut their budget, they have an increasing deficit and with no signs of fixing it. How much do you just stay clear?
I think that's exactly what you do. So I think we've been recommending and following an underweight position relative to French government bonds relative to other countries in Europe. They're being helped by the fact that German bond yields keep going down. So although the spread's widening, absolute borrowing costs are not rising that rapidly. So they haven't risen to the levels we saw in the sovereign crisis back in early part of the last decade, because German bond yields weren't just rising everywhere and causing punitive borrowing costs. So borrowing costs are not really a constraint on French borrowing at the moment, but they could be over time. How is it resolved? Usually it gets worse before it gets better, and forcing actions which are painful to somebody but actually resolves the problem going forward. Think about today that Greek 10-year bond yields are lower than France, when Greece was completely insolvent 10 years ago.
So this raises a question is there a certain profile of countries that are susceptible to bond vigilantes versus not? I think about the likes of France, yes, maybe Greece, although not anymore because evidently they trump France. But in the U.S., it seems like the U.S. is immune to the potential for bond vigilantes, even though the debt to GDP looks like it's on a trajectory that's far worse than any of these countries.
I think it's a couple of things for the U.S. One is the exceptional performance of the U.S. economy and the exceptional position of the U.S. dollar in the sense of a global reserve currency, and President-elect Trump has talked about that important aspect of having the exceptionally strong currency around the world and use of it around the world, which gives the U.S. a special sort of situation. It would borrow its own currency, and everyone accepts the dollar for global payments. Over time, however, things can get out of control. We saw that in the UK with Liz Truss's government for a little while. But that's farther down the road, and the issues in the U.S. aren't insoluble. They just need to be dealt with, and they can be dealt sooner the better, because modest changes can affect the trajectory meaningfully over the next 10, 15 years. So it's more about, I think, the next couple of years. Where is the new administration going to be with regard to containing the growth of the deficit and debt overall? If it's not contained, if it continues to grow bigger, at some point in the next several years, I think there will be a constraint on government policy, which usually creates an adjustment.
Michael, we should perhaps acknowledge there is something somewhat unique about this moment. These issues are arising in Europe outside of recessionary conditions. We saw that in the UK, we're seeing it in France. We're running budget deficits north of 5% in America, with GDP running at very robust levels and unemployment close to 4%. My question really is how these bond markets will behave in economic downturns. In developed markets, they are bought. When things go wrong, you buy those bonds. Are we going to challenge that next time around?
It could be, and how we fixed it last time with quantitative easing, right? When to make sure that monetary policy or deficit problem, inflation problems did not cause problems for long-term interest rates, the central bank stepped in and bought trillions of dollars of government bonds to support the monetary and fiscal policies being used. But down the road, if central banks feel constrained and don't want to do that, then it becomes more problematic.
Does this become problematic for portfolio construction?
It does. Because inflation has been actually going up a bit in the United States lately in the last couple of months, or core PCE data, which is what the Fed's preferred measure of inflation. That's been going a little bit the wrong way. The unemployment rate has been coming down a little bit the last couple of months from the levels we saw in September, putting a little more pressure on the Fed. Maybe we shouldn't be easing too aggressively going forward, given the situation, which again puts upward pressure on bond yields.
This has got to be the number one question going into a potential economic downturn. Let's assume we get one. Do bonds behave as a ballast in the portfolio next time around?
It depends on what causes the downturn and whether it's stagflationary. But ultimately, it's a great question, because if you do not get that kind of haven reinforcement of bonds, that really limits and ties the hand in terms of the fiscal response to any potential downturn. And that is the fear that people have, including the Federal Reserve. Maybe the reason why they are acting a little bit more carefully right now as they try to thread this needle.
Michael, good to see you. Great to catch up. Michael Cushman there of Morgan Stanley. Next up on the program, Tom Kennedy of JP Morgan, Dana Taussey of the Taussey Advisory Group, Claudia Sahm of New Century Advisors. As we look ahead to Payrolls Friday, we'll also catch up with Tom Titsouris of Strategas. The third hour of Bloomberg Surveillance is just around the corner.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Well, when I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now. I will show you how to get the best funding for your startup idea.
Wednesday at a conference, because it raises the question, what do they want to be messaging at a time that does seem pretty fraught with accelerating growth, at the same time that they seem to be on a somewhat preset rate-cutting path?
We don't assume, we don't speculate. You remember the lines coming out of the news conference?
Yes.
How much speculation will they be doing this month, looking out to next year and beyond?
How much do they try to remove the political tinge to this by just saying that the economy has been performing better than we expected? That, to me, might be more interesting as a way to subtly communicate that they are having a shift in sentiment on the Federal Reserve Board.
So there's a two-part story before we get to the big one on December 18th. Payrolls this Friday, CPI next week. BMO's Ian Lincoln reckons you need a strong report on Friday and a robust CPI number, signaling maybe some sticky inflation to get this Fed to pause on the 18th.
Otherwise, why not just cut rates and signal that they're never going to cut rates again? Because there's essentially a lot of people are getting on board with that, and it leaves them open to a lot of political leeway, because you have to imagine that 2025 will be all about Jay Powell defending the independence of the Federal Reserve at a time where he already has staked out his territory with a very definitive, I will not go.
We might have a shadow Fed chair, mightn't we? Kevin Walsh? Who knows?
Let's see. Let's see how this goes. But all I know is that he was very definitive when asked about it. And that was a response of a lawyer who had prepared his brief.
Agreed.
And is prepared.
That was the standout moment from the news conference about a month ago. Coming up this program, we'll catch up with Tom Kennedy of JP Morgan as the S&P 500 caps its best month so far this year. We'll speak to Dana Towsey of the Towsey Advisory Group on a record-breaking Black Friday, and Claudia Sam of New Century Advisors looking ahead to November payrolls. We begin this hour with equity futures just about unchanged, following the best month of the year on the S&P 500. Tom Kennedy of JP Morgan looking ahead to the last Fed meeting of 2024 and writing odds of a pause have grown meaningfully. The labour report on Friday really matters, particularly the wage data. We view risk to the soft landing as balance between recession and inflation re-accelerating. Tom joins us now for more. Tom, good morning.
Good morning.
Two very, very different risks for 2025. What are you telling clients they should do?
I think it's just balancing out their portfolio to make sure you feel comfortable with your strategic asset allocation. Are you aligned there? Do you have big overweights? Are there places we can correct? I think heading into this meeting in December, it's really fun to just play this game that you guys are going through here. First thing they're going to look at, what's the probability the market assigns to a rate cut? 65% as we sit here today, so they're getting good optionality. But the really important thing they're going to do is check in on their SEP from September. Growth number for 2024, 2%, is too low. Inflation number, 2.6% core PCE, that's too low. And the unemployment rate, they have 4.4 in for 2024. That's probably too high, which is why we come back to this report on Friday, why it really matters. Well, I agree with you guys. Last month for payrolls was an anomaly. We got to make sure we're still on a really good track here, and then the Fed will have optionality. That's really what I expect out of Powell this week. He's going to try to just confirm that he has optionality. That's what data dependence is.
Well, based on what you've just said, I'm not sure what the options are. Because if you go into this meeting and you revise growth higher, revise inflation higher, and revise down unemployment, how on earth are you cutting interest rates?
Yeah, I think it's going to be now about where is this neutral rate estimate that you have. Lori Logan, who's the president of the Dallas Fed, gave a great speech last week. Could have been the week before. Just about the range of...
It's all a blur, Tom, don't worry.
The range of outcomes on neutral and the range of estimates. And we are getting to the top end of that range. Now, I think what Lori was trying to do is to say that we are data dependent. We're going to have to feel our way out here, but we're getting to the top end of the range. And the market really has responded by pricing in more pauses into next year. I think that's the real question that they'll have to come out with. If they do end up cutting, it's just going to be about rates are just restrictive still here, and we can cut and still get that soft landing.
You mentioned the game that we were playing and that we have fun doing it. There's a question about whether it matters even right now, given the fact that it seems like the Fed has kind of taken a back seat to just the actual raw economic data and the headline policy making that seems to be happening. So do you think that it matters? Do you think that ultimately whether they cut or they don't cut, it's going to make a big difference for a lot of investors?
The way I really think about the does it matter or not is, if the reason they're pausing is that the economy continues to surprise us for the upside, which going back to my notes with you guys for the last 2 years, that's been a theme consistently, the U.S. economy surprising to the upside. If that's the reason they're not cutting, well, what's the type of equities that I really want to own? And if the event that they're cutting because the world is slowing, do I have the right types of ballast in my portfolio to keep my portfolio as resilient as it can be going into 2025? For our outlook, resiliency is a big piece of this, because when I look at client portfolios, they tend to be still overweight risk and overweight cash, not a very resilient portfolio.
You talk about the two bifurcated risks, one of recession and one of a reacceleration in inflation and growth. Do you have one scenario that seems more likely than the other? And if the Fed were to cut rates in a couple weeks, as most people expect, is that risk of a reacceleration that much greater?
I think the point of saying that they're balanced between these risks is that it's a more normalized environment than what we're willing to appreciate. For the last 15 years, we have had the comfort and resiliency of the Fed forward guidance. And at the moment, we just don't have any forward guidance. So in your portfolio, those balance of risks being relatively equal is to really signal from our perspective to the world that is your portfolio really balanced for the risks in the outlook looking forward. Go ahead.
Well, what is the ballast for a recession?
I still think it's going to be the Treasury market and core bonds. Talking about this in the prior segment.
Yeah.
The real point of it is, where would you go when the economy and revenues for your stock that you own, those revenues are deteriorating? Where are you going to go to hide? What are your real options? I don't really think there is anything else besides the Treasury market at the moment. Is it cash? Or really what we're trying to push our clients into is thinking about alternative ways to find income that are long duration. In our family office survey from this year, 45% of the wealthiest families in the world own alternative assets. Historically, we would say, oh, you can't own alternatives because they're illiquid. Well, 50% of all of our private asset alternative raises this year were in evergreen products. The market is changing. The ability to financialize alternatives allows people to own real estate, infrastructure, different assets for income that don't need to necessarily be tied just to the Treasury market.
Completely depends on what the objectives are, but certainly if you're retiring, you don't need the money for 20 years. You've got to ask yourself why you need the daily liquidity. This is an argument that Apollo has made repeatedly over the last few years. Do you see clients changing their attitudes to alternatives?
Absolutely. I think if you look out 3 years from now, every single one of our clients will have more alternative assets in their portfolio as a percentage than they do today. This financialization helps them, but also in the private space, things are evolving as well. The secondary market is growing. Get more liquidity in your existing private equity alternatives. And then also private credit. How many years now? Private credit's a bubble. It's a key piece of the financialization, and it's adding liquidity to sponsors at a time when they need it, and investors are willing to take the higher return.
Who loses out? And when I say who, I'm thinking about what asset class, what securities would typically attract that money, but won't anymore.
I think it's mostly going to be about how do banks adjust themselves to be a part of the lending solution here. There's concentration happening in the banking sector as well. I don't think it really does crowd out things, John, in the way that you're talking about it, saying money has to come from the public space to go to the private. IPO issuance is non-existent. When are we really going to ask the question of why are we expecting IPO issuance to go back to what it was? I don't think we should. The private business owners don't need to go public anymore. There still needs to be a certain amount of that just for the sponsors and the private equity back, but we don't really think IPO issuance is going to go back to where it was. So just the nature of new assets and new money is going to flow there.
This raises a question, and I just think of Adina Freeman over at the exchange, screaming, throwing things at the screen as she listens to you. And there's been this argument that actually, if you don't have companies going public and putting the disclosures and having the same kind of transparency, that somehow impedes the integrity of the system. Are you saying that that risk has not materialized and won't materialize in a lot of markets that people traditionally have thought of as more obscured?
I think you're going to need to see transparency come to that market. We're already seeing transparency. JP Morgan provides most of the leverage to the private credit space. What does that mean? A sponsor who's giving the loans out takes leverage from a bank. So they're still connected to the banking sector. And that affords transparency for us to see those individual loans. I just think the nature of transparency will change, Lisa.
Is the argument that essentially traditional asset classes, bonds, stocks, aren't going to have the same kind of returns going forward because we brought forward a lot of those returns and because yields are higher?
Not necessarily. I mean, you look back in history when you see big years like the one we just had. Over the last 75 years, if you see a 20% gain in the S&P 500, on average that next year, you're up 10%. And about 80% of the time, you're up the year after. So markets can do well. I'm just saying the nature of where the earnings for these businesses is happening is shifting from public companies to private companies. And this, my clients need to adjust alongside it and invest alongside those earnings. And that nature, I think what I'm trying to draw out here is, when are we going to ask, this is a constant, perpetual change? Reversion to the mean in this sense is unlikely to happen.
You touched on it. Key overweight, big favourite for next year, financials, the banks. And part of it is the IPO story, all of this activity picking up again. Are you questioning that allocation going into next year?
No, I think
you still like the financials.
I think financials look fantastic from a perspective of earnings growth changes happening. That's alongside the soft landing, and you can actually see leverage start to accumulate. It doesn't have to be the IPO market. It can be leverage accumulation or leverage extension elsewhere. Also, the curve should start to normalize here, again, incentivizing the lending market to pick back up again. And from a valuation perspective, it looks relatively attractive to other things we have. So financials is a key overweight for us, and then also industrials and utilities. Tech as well, but we're broadening out that tech discussion. It's happening last 3 months for sure, arguably somewhere in the 6-month range. You're seeing the broadening out. That's where we expect earnings to accelerate the most in those three or four sectors.
Utilities have been part of that tech discussion for most of this year. Tom, it's good to see you. Appreciate it. The conversation I didn't expect to have about capital allocation and some of these big shifts we're seeing.
But it's actually really relevant at a time where there's been so much money flowing into the United States and U.S. exceptionalism, and people say valuations are high, especially if a lot of these public companies comprise a much smaller portion of the overall investing market than they have traditionally. So it's one that we have to keep going back to, even though it's not exactly in tandem with some of the more visible balls and strikes.
Mark Rowan's been saying it repeatedly to us on this program now for the last few years. Equity futures right now on the S&P just about unchanged. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The French government is seeking to avoid being ousted from power in a no-confidence vote. Prime Minister Michel Barnier offered a final hour concession to Marine Le Pen's party on the 2025 budget. His office says that he has committed to not cutting reimbursement for medicines. France's parliament is due to convene at 3 p.m. Paris time. People familiar say De Beers has cut diamond prices by more than 10% across the board. The Anglo-American unit has tried and failed to put a floor under the slumping diamond market. Man-made diamonds and the collapse in China's luxury market have both undermined prices. The price cut is its first since the start of the year and a historically large reduction. The Buffalo Bills are headed to the playoffs after last night's 35-10 win over the San Francisco 49ers. The freezing temperatures and continuous snowfall couldn't stop Bills quarterback Josh Allen with 4 touchdowns, including 1 rushing and 1 receiving. The defending NFC champion 49ers season continued to go downhill last night, with Pro Bowl running back Christian McCaffrey injuring his knee on a non-contact play. Week 13 continues tonight with the Browns and the Broncos on Monday Night Football. That's your brief, John.
Danny, thank you. Those fans dedicated. Did you see the conditions?
Oh, yeah, there was like snowball fighting.
Ridiculous.
Well,
They're like wading through snow to find their seats in the stadium.
It just adds to the extremity.
How doesn't that game get cancelled?
Of course not. It's like ice fishing, except watching football. It's honestly, it's wonderful.
That's
it's extreme.
enjoyable.
Well, you then play in the snow. You feel like you're hardcore. You go home, you have war stories to tell your children. I absolutely endorse
You
it.
get ill, you don't go to work.
Oh, come on, have some fun.
Okay, apparently that's fun. Up next, the morning calls plus Dana Towsey of Towsey Advisory Group as retailers see record online Black Friday sales. That conversation is up next. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The opening bout 1 hour and 13 minutes away. Equities are doing okay, just turning positive in the last few seconds. Yields are still higher by 3 basis points. The 10-year 4.20.32, and the dollar stronger against everything in G10. The euro down to 105.11. Time now for some morning calls. First up, Stifel raising its price target on Tesla to a street high, noting confidence in its FSD capabilities and Cybercab promise. Your second call from Guggenheim, downgrading Coles to neutral, citing softer sales and a CEO transition. That stock is up by about 0.4%. And finally, JP Morgan upgrading Gap to overweight, saying the company is at an inflection point to support sales growth. That stock up again by 4.8%. Let's stick with retail. Retailers seeing a record-breaking Black Friday. Data from Adobe Analytics showing consumers spent $10.8 billion online as they look for the best possible deals. Dana Towsey of the Towsey Advisory Group writing, the theme of holiday 2024 is one of selectivity, whereby both consumers and retailers are more discerning in allocating dollars. Dana joins us now for more. Dana, good morning.
Good morning.
Busy few days for you. You've been into the store so we don't have to. What's it like?
I think overall, traffic built as you went on through the day on Friday. You don't have the morning rush like you did in the past because the promotions are elongated and you could have gotten the deals even earlier on. But the going rate seems to be 30% off. You could get additions to that as you go through the weekend. And today's Cyber Monday expectation is for a 6% increase in online sales on Cyber Monday.
Is it a legit 30% off? Because there is a take at the moment for consumers. I think they've started to believe that maybe these deals aren't really deals and that maybe they're being misled somewhat. Are they real deals?
They're real deals. They're real 30% off. Look at the inventory levels. They're not piled high to the sky like they had been in the past, but you're getting the deals for the event-driven spending that's out there. And retailers know they have to promote to do that. Look at the traffic we saw. We had teams around the country, and basically whether it was Abercrombie & Fitch, Victoria's Secret, Bath & Body Works, Ulta, Sephora, Lululemon, we saw lines. Now, is it all day? It's in the height of the day when you saw that traffic.
never change, John. Are they really deals? How are they just trying to mess us over? I do.
Say it's 30%, but it's 30% off a price they charged for about 5 minutes a year ago.
Right. Well, this is the reason why people are more selective and discerning with their money and then put things in a basket and wait for an additional 10% off. So if you want to do that, the Farrow household is open to you. I am wondering if there are certain types of stores that saw traffic as people became more discerning about the experience, too, that they wanted to be having.
I think you saw the specialty stores, probably Victoria's Secret with the lines that they had, that was compelling. You haven't seen those lines in years past. Bath & Body Works always has a line on Black Friday because of the deals that they do give. And then what you saw at Hollister's level of promotions was 30 off. Last year it was 40 off. We have a tracker that goes back to 2018 showing the differences in the level of promotions. And for the most part, Nike was the one that was a little bit more promotional than it was in the past, which is not totally surprising.
Do retailers like that e-commerce is taking such a big slice of the pie? And I don't mean this in terms of other people's, but I mean even their own. Is it less profitable for them to sell online with all of the returns and the processing and the expectations that come around that?
Overall, you need both. And what you're seeing today is a lot of the stores fulfill a lot of those online orders or the buy online pickup in store. Overall, online sales are still an important part, but still physical in-store shopping is the greatest part. You're not seeing the big pickups in traffic because people have been shopping all along. But physical retail and the newness of stores that are out there, look at the new Aritzia store that opened in Soho. The traffic was big there on Thanksgiving Day when I was there, and even on the Friday on Black Friday too.
To John's point about, is this really a deal? How much of these stores cannibalized from the excitement around the post-Thanksgiving shopping moment, given the fact that these deals stretch over a longer period of time and feel like an evergreen type of event?
So overall, retailers buy for events. Retailers will buy for promotional time periods. We always know that traditionally after Thanksgiving weekend, you go into a lull until the 10 days before Christmas when a lot of the shopping is done. But you look at this year with 5 fewer days than what you had last year, Black Friday weekend could account for nearly 20% of the holiday season sales for the week of the whole Black Friday week. Because now you have fewer days in order to when we get to December 25th.
Dana, who's winning?
I think overall you have Abercrombie's winning, Hollister's winning. Frankly, Victoria's Secret did well. I think Old Navy is taking share. As the weather got colder, people started to buy. Walmart's winning. You look at value, look at the traffic in TJX and TJ Maxx, which has become more gift-oriented.
I'm not going to ask you what the correlation is between temperature and Victoria's Secret, but you've mentioned the company a couple of times. I'm not sure it's the winter weather that's doing that. What if they changed? Why is that company making a comeback?
I think some of the stores are retrofitted. I think some of the product lines are retrofitted. They reintroduced sport. They reintroduced bathing suits. They still have a long way to go. But notice lines there, which was different than we saw last year.
I think that there are a lot of theories out there about why that store has come back.
Yes.
And I think that we can explore them at another time. I do want to just take a bigger question. Of course, you're like, why not explore them right now?
No, I'm genuinely curious now. Now you've mentioned it, you seem to know something I don't.
Yeah, well, they changed the look, right? So it had been going for a very progressive kind of everyone's body is wonderful kind of look, and then they reverted back to, you know, the Victoria's Secret.
Oh, Hot's made a comeback. We're doing this in real time.
Please.
Is that what it is?
Can you explain, Dana?
Basically, you have a new leader who came in. She's going to basically retrofit the brand. She's Hillary Super, knows how to merchandise. Let's watch the next year and see how it progresses.
What has she changed so far?
She just started September 9th. So it's first to come.
So what do you think is bringing the crowd back?
So the categories that are coming back, like the sport category that wasn't there last year at this time.
Oh, so they're challenging who now? They're going after Lulu?
No one's going after Lulu. Lulu's on its own because, frankly, what we saw this weekend, Lulu had the most traffic. If you look in that segment, Aloe second, followed by Vuori third.
Let's talk about Vuori, some of the private market challenges. How much of a challenge are they providing to Lulu?
I think overall, when a category gets so popular and the margins are so strong, people come in. But when you look at what makes a leader, A leader's driven by the technology innovations that they have. Lulu's going to report their earnings later this week, and it'll be interesting to hear about the newness they're putting in, both in terms of their core men's product and women's product. And don't forget the growth in international.
Vuori versus Lulu. Bramo, you know that story well.
Well, I like Vuori, but I have Lululemon products as well. I just noticed that Lulu actually ended up not having the same quality that they previously did, and so there was a quality shift, but that seems to have revived. And I will just say, Lululemon does report earnings this week, I believe, so we will get an update on that.
For that. And if you go into store and wait long enough, someone will come in and clear off the shelf and walk out. That's been the experience. Have they fixed that yet?
I think overall what they fixed in terms of the product, it is more colors are in the product, being in stock on the right goods, and having the right fit. I think Vuori started as a men's brand. It's known as soft casual. They've added women's, and they're still in the growth phase.
Dana, it's good to see you.
Nice to
Appreciate
see
your
you
time.
too.
Thank you. Thank you for the update. Dana Towsey of Towsey Advisory Group on U.S. retailers.
Okay. There was a whole discussion around Victoria's Secret where they were going to get rid of angels and do what women want, not necessarily the Victoria's Secret angels. And I believe that the angels have made a comeback. So it sort of has evolved.
It starts there.
It starts there. And I think that that's part of what's behind some of the shifts there.
It's become more aspirational again?
I mean, I guess so. Yeah, it's become more of a vision of lingerie.
Okay, interesting.
We did this really well. This is great.
Let's wait for next year and see what they have, because then Hillary will have made an impact.
Okay.
Up next on the program, not that. Claudia Sam of New Century Advisors and Tom Sitouris of Strategas from New York City. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equity futures here positive across the board on the S&P, on the Nasdaq, on the Russell. The small caps outperforming once again, up by more than 0.25%. With 60 minutes until the cash open, let's get you an update on your morning movers. It's Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. So the headline on Stellantis is that Carlos Tavares, the efficiency czar, is to go. But it's the vault face that really grabs me, which is it goes from unanimous support for him to stay until 2026 to this to leave with immediate effect. This is essentially questioning the capacity of the efficiency czar to take the company forward and the direction they want to go in. Chirin, we have a problem. That was the message from Michigan. He won't be missed here in the United States of America, where you've got Jeep, Ram, Chrysler, and Dodge. The U.S. dealer said it was reckless short-term decision-making that they opposed. Cities say you've got a dissipation of market share here in the United States of America. This is less about the problem with China. Just look at what they had. They had a market share of just under 12% in the second quarter of 2022. That is dissipated to just under 8%. This is not a China problem. This is a USA problem with sales. Roll it over and have a look at NVIDIA. It's a hard call here, down 0.25%. But what is the headwind, or what is the opportunity from the new set of regulation that the Biden administration has lobbied and leveled on top of the chip industry? 140 new companies will be restricted in terms of what they can sell, but Bridgewater sold 1.8 million shares at the end of the third quarter, and they lumped up and bought Supermicro. So a little bit of a backstep for NVIDIA this Monday morning. You've just finished a conversation about retail, but it's worth pointing out that for Gap, you've got JP Morgan upgrading the stock to overweight from neutral. They put a price tag of $30 on this, so there's about 23% left in the upside. Why? They had a meeting with the CFO and the CEO. They believe the story. They believe in the reincarnation. They believe in the marketing story that has been delivered. The line is a consistent playbook of improved merchandising, marketing across all four brands. And just to let you know, I got the full 30% off, and I feel I really did accomplish a bargain in Black Friday.
Good work, Manus Cranny. We're proud of you. Thank you, Manus. Thank you very much. Manus Cranny on some of the movers. Here's another one. Breaking news. Intel. The stock so far this year down by more than 50%. This headline will not be a surprise. Intel announcing the retirement of the CEO, Pat Gelsinger. The board has formed a search committee for his successor.
Yeah, this comes at a time where other chip manufacturers have done very well, and as you mentioned, the share's down 51% so far this year. He will also be stepping down from his position on the board. The foundry leadership is going to remain unchanged. Basically, the only thing that changes is that Pat Gelsinger will not be there. And you've made the point, John, that how do you feel as a leader when you step down and the shares go up? And that seems to be where things are, at least in the initial reading.
We say this all the time. You can learn something from the data and how the market responds to that data. The market's responding favorably to his exit. The stock is up by 3%. The hard work that's got to be done here, though, how offside this company is relative to where it needs to be for the market right now. Obviously, the winner at the moment is the likes of NVIDIA. What does this company need to do in the coming years, and I would say the coming decades, to improve things? This is a big turnaround effort.
Yeah, especially because their hands are somewhat tied due to the grants that they've gotten from the government in terms of how it's going to be deployed when they get that money. There are a lot of questions about how quickly you can turn around a ship in a fast-moving industry where there is a clear leader and they are gaining ground. Also, if Intel is going to be the national champion in the United States, how do they beef up their production in the U.S. when there isn't necessarily the expertise in a mass group of people who could actually make the products the same way that there is in, say, Taiwan?
We will, of course, have more updates for you through this morning. Just to go back over that breaking news from moments ago, Intel announcing the retirement of its CEO, Pat Gelsinger, the board conducting a search for a new CEO. That stock is up in the pre-market by close to 5%. 3% now. Let's turn to the Federal Reserve. The next decision 2 weeks from Wednesday. After payrolls and CPI, Claudia Sahm of New Century Advisors weighing in on the Fed's future. Writing for both the Fed and other policymakers, now is not the time for complacency. Watch the labour market and the rate of business formation. If they slip back and become less dynamic, then productivity and supply-driven growth could slip away too. The US economy has come too far in the last few years to allow that to happen. I'm pleased to say that Claudia Sahm is back with us now for more. Claudia, welcome to the programme. I think we should start there, the supply side of the economy and how much of the hard work that's been doing so far over the course of 2024 and where it leaves the Federal Reserve as it thinks about 2025 and beyond.
Right. Well, it is so important that we don't just look at a GDP number and say, oh, it's almost 3%. And move along. We need to stop and think, what is going on? Why is growth so good? Are we overheating? If we're overheating, then the Fed steps in, they raise rates, they cool things down. That is not what's happening. We have seen a real pickup in growth. Remember, we were promised a recession and we got an acceleration. And we've seen for 2 years running now almost 3% growth. And a lot of that, if you look under the hood, is coming from productivity. And that is the holy grail of economic prosperity. And we should be spending a lot of time trying to figure out exactly how did we get to this place that we've seen a pickup in growth. And this is something the U.S. is seeing and our peer countries are not. So it's a really important question to dig into.
Claudia, given that people believe, and yourself as one of them, that this is becoming a productivity story, does this mean that from your perspective, it's not inflationary, that it doesn't necessarily preclude the Federal Reserve from cutting in a couple weeks' time?
Right. Inflation happens when demand is outstripping supply. That's the 101. There's more to it. But in general, if we have too much demand and not enough supply, then we're going to get price increases to kind of, make the market work. But if we can get more supply in there, and that is the lesson. We did not get the big disinflation without a recession, without this supply side help. And we got it not just from supply chains, we got it from workers coming online. And we also got this kick of getting people in more productive positions, getting more capital in their hands to do their jobs. And like that was such the way to solve the problem of the high inflation. Well, that's not the only problem that a good supply side solves. It also can really help us thinking about growth over the long term. But we got to get out of our head that it's like all growth and the Fed does interest rates. Like productivity is a really tough nut to crack, and it actually is not primarily about the Federal Reserve.
Claudia, how does Fed Chair Jay Powell message this at a time when he is going to be speaking on Wednesday at a moderated conversation ahead of a time where inevitably, as we've been hearing from a host of analysts, the Fed is likely to revise a lot of its projections with inflation going up, with unemployment going down, and with growth also going up, given the fact that you have seen those upside surprises to growth?
Powell has made a real effort on this, and I would just kind of tell him to, double down on it. He said multiple times the Fed doesn't have a growth mandate, but that's a kind of a wishy-washy way of saying that sometimes when growth is high, the Fed needs to step in, and sometimes when growth is high, the Fed needs to get out of the way. And this is one of those times where the Fed needs to get out of the way because there's productivity there and high interest rates being unnecessarily restrictive on the economy relative to the dual mandate. It has costs. This high growth is not guaranteed. Unfortunately, that is the thing about productivity that we have learned from the past is, yes, sometimes we get it and holding on to it is what is really hard. So we should not be taking this lightly, that we've got this kind of growth pickup, this productivity renaissance. The question should be, what can all policymakers, and frankly, a lot of these levers are not with the Fed, they're with fiscal or other government authorities, but what levers can we pull to keep this going? And Powell continuing to go back to his dual mandate of the price stability and the labor market, the maximum employment, I think is important because the more we've dug into and researched with this productivity boom, it goes back to the labor market. The dynamic labor market is very much tied back to the dynamic economy, the higher productivity.
Well, let's talk about the labor force growth that we've seen, Claudia. And I wonder from your perspective whether you think it's distorted the Fed's understanding of the influence that they actually have over inflation.
I think the Fed has been very humble and open to the fact that there's a lot that's going on with inflation that we don't understand. And I think they have been probably clearer than a lot of the people watching the Fed that their tools have been they're limited, right? There's a lot of dynamics of inflation that have had to do with the supply side that are not primarily about the Fed. The Fed does have a mandate with inflation. They have stepped in. They do need to pay attention. And when we see
inflation picking up, they would step back in. So it's not that the Fed is out of the picture with inflation. I think they have tried hard to make it a more nuanced conversation. Nuance is tough, right? But they can't give up on this. And I think this balancing the two sides of the mandate and just saying, hey, this is not about growth. High growth does not mean we need to hike. High growth does not mean that we have no reason to cut. It's our dual mandate. And the growth conversation is a separate piece of this. And if we have to look under the hood.
We enjoyed this conversation. It's good to see you. As always, Claudia Salm there of New Century Advisors. Claudia, thank you. Of course, Claudia mentioned we will hear from Chairman Powell later this week. We will get payrolls on Friday as well. So 2 events you need to look for. Next week, we'll get CPI. The week after that, a Federal Reserve decision. Mike McKee joins us around the table with more. Good morning, Mike.
Good morning. And we just got, while you guys were talking, 2 more speeches added to the Fed calendar this week. Tom Barkin of Richmond is going to be speaking on Wednesday and Thursday. So overall, we have a significant number of members of the Open Market Committee who are going to give us their thoughts. The only one that's really going to matter is Jay Powell, of course, as always. Where he is where the markets anticipate that the Fed will end up. And the real question is, what is he going to be able to say about where the Fed ends up, given that jobs isn't until Friday and CPI isn't until next week?
They all matter. I enjoy every single speech. I just want to say thank you for adding to them.
This doesn't sound sincere at all.
I actually think it's fascinating, and I think it's fascinating that they're being added now. Because yes, it's before the quiet period, but also it's at a time where there's a real question about A, the Fed's independence, and B, how they're going to address some policy changes that are going to come down the pike that potentially could have a pretty significant impact on the economic outlook. How much is this trying to get ahead of that? To sort of come out there with terse answers to some of the questions, with Jay Powell saying, I will not go if I am asked.
Well, given the way they schedule, I don't think most of this is based on that. Some of it is an opportunity, shall we say, to talk about that. But when you look at what they've said about Fed independence, it's basically the same couple of sentences from every one of them, that it's important because it gives the Fed credibility, and you take that away and then the markets have a problem. They don't really go beyond that, and they don't want to talk about the guy who's going to be president. We shall not mention his name if we're on the Fed. The framework is now going to start being part of what they talk about. And Chris Waller's speaking today on that. There was an interesting Bill Dudley column you talked about earlier that said the Fed has some work to do there. And so we'll see how far these people want to go in sort of front running that. But the rest of it is going to be just kind of talking to their constituencies, especially the Fed bank presidents who are out talking to Rotary clubs and people like that, universities in their districts.
Tons of Fed speak coming up this week. Mike McKee on some of that Fed speak for you. Going into it, bond yields are higher across the curve, up now by close to 7 basis points on a 2-year. On a 10-year, up by 6. So just pushing higher after dropping through last week. With us around the table is Tom Tsouras of Strategas. Tom, good morning. It's good to see you.
Hey, good morning.
In the past, you've talked about this marriage between full employment and declining inflation. I think you said the honeymoon was going to come to an end. Has it come to an end already?
I think so. I think we're going to see inflation trickle a little bit lower from here. But I think for the most part in 2025, we're going to see it moving sideways. Let's say somewhere around 2.25% to 2.5%, both core and headline CPI, both converge around there. So a little bit lower. But I think that by the middle of next year, we're starting to see the second wave of inflation beginning to emerge.
Where is it coming from? Is it coming from policies or just naturally already existing inflation?
Well, history says, and we've looked at this data over 200 years of developed economies, about 85% of the time you get a second wave of inflation because the first wave is caused by something structurally changing, and it is amplified by fiscal and monetary policy. But the initial change is a structural shift in the economy. And I think the structural shift in the U.S. economy was the labor market became exceptionally rigid. COVID accelerated this. But the labor market became exceptionally rigid as we transitioned from the baby boomers retiring and leaving with the skills employers demanded to having the Gen Zs and millennials not necessarily having those skills just yet and being geographically rigid about where they wanted to work as well.
When you start talking about potential policies to come down the pike, how much is it really immigration and potential clampdowns on that could be more inflationary than, say, some of the tariffs?
Yeah, I think we've looked at this as well. In tariffs, what we found was, and we don't take credit for this work, but we're kind of quoting work that we've seen, but tariffs would add perhaps between 0 to 1% to CPI over the next 10 years. It's a pretty negligible amount. It could be worse if there's essentially a retaliation tariffs, but it's not a huge impact. The deportation of labor has a much more substantial impact over 10 years, upwards of about 10% impact on CPI total. But the catch with that is there's a lot more uncertainty, and the reason for that is because you have to estimate what is the household formation rate of these households going to be, childbirths, their demand for housing, and what impact will that have on consumer goods and consumer prices. We don't know that answer yet.
Let's talk about immediate policy decisions, about 2 weeks away. Federal Reserve, are they hitting pause in December?
If they want to maintain this perception that they're independent, I say no. And let me speak to that. The Fed, in my opinion, has pigeonholed itself and has telegraphed too much easing for the next 12 months and an end to balance sheet reduction. If they pivot away from that, it's going to optically look politically motivated. I think they're stuck. Now, the data coming out Friday could make the case, if it comes in strong, that they don't have to go in December. But any sort of hawkish talk is going to look very suspicious.
What's the difference between being politically motivated and being policy motivated?
Well, I guess the way I'd say it is they made quite a bit of effort in the last 12 months to communicate, particularly an end to balance sheet reduction. Those types of efforts, for example, putting out a new piece, a metric on their website talking about reserves in the system. This is their way of telegraphing that they desperately want to end balance sheet reduction. Even if the data changes, then they shouldn't have telegraphed that desire to end balance sheet reduction. 12 months ago, we were talking about Dallas Fed president speaking about the need to almost immediately end balance sheet reduction. They really kind of got ahead of themselves with that. So if they change course now, despite the fact that the data has improved since January, February, it's going to look suspicious. The market is going to see that as politically motivated.
So if they cut, how much do you not like the long end of the yield curve?
Well, for now, we actually like it because we see the next 3 to 4 months a liquidity bonanza coming in. We see upwards of 75 basis points of cuts coming between now and June. It's not a huge amount, and that's roughly what's priced in. We see a debt ceiling standoff taking place from December 31st, at least out to the middle of the first quarter, because despite the unified government, Republicans in the Senate are going to hold Donald Trump's feet to the fire on the budget for 2026 and going forward. So there's going to be a debt ceiling standoff. And we have this unintended consequence when we have a debt ceiling standoff where liquidity comes out of the Treasury's general account and goes into bank reserves. That actually flattens the Treasury curve. On top of that, the deficit should be substantially smaller next year. So for the first half of next year, we could actually be looking at a shortage of treasuries temporarily until we raise the debt ceiling. So we're actually bullish on duration until we get through that debt ceiling raise. When we get through that debt ceiling raise, it's off to the races again. Bond vigilantes are going to find that there's a new appetite to come in and put shorts on.
Then all bets are off. Tom, it's good to see you. Tom Sitouris of Strategas, his view on the next 12 months. Some breaking news for you in the last 15 minutes if you are just joining us. That breaking news comes from Intel. Intel is up in a pre-market by about 4%. On that news and some stories elsewhere, let's cross over to Danny Berger. Hey, Danny.
Hey, John. We begin with that breaking news. Shares up 4% for Intel. The company announcing the retirement of CEO Pat Gelsinger. After a 40-year career with the chip maker, Gelsinger also retired from the board of directors effective yesterday. The board has formed a search committee for a successor. Shares of Intel are down more than 50% so far this year. People familiar tell us that BlackRock is nearing a deal to buy private credit manager HBS Investment Partners. The agreement could be announced as early as this week, valuing HBS at more than $12 billion. The deal would give BlackRock, which manages $11.5 trillion, more than $50 billion of alternative assets. And it was a record-breaking weekend at the movies. AMC Theaters said more than 8.8 million went to the movies between Wednesday and Sunday. It was the company's biggest 5-day Thanksgiving period in its 104-year history. Disney was also a big winner. Moana 2 broke the record for highest-grossing Thanksgiving weekend with $221 million in ticket sales in the U.S. and Canada. And that's your brief. John.
Danny, thank you. We'll pick up on that Intel story in just a moment and catch up with Mandeep Singh of Bloomberg Intelligence on the other side of this commercial break, as well as setting you up for the week ahead as we count you down to Payrolls Friday from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The open about 39 minutes away. Equities just about unchanged on the S&P 500. Your week ahead looks like this. Today we'll get ISM Manufacturing plus S&P Global Manufacturing PMI. On Tuesday, JOLTS. Wednesday, remarks from Fed Chair Jay Powell plus ADP private payrolls and the Fed's beige book at 2 p.m. Eastern. On Thursday, the trade balance plus another round of jobless claims. On Friday, UMich sentiment and, of course, the big one, Payrolls Friday, the November payrolls report coming a little bit later this week. Got to get back to that breaking news. Intel announcing its CEO, Pat Gelsinger, is retiring effective immediately. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, the stock is higher by 4%. On the session, it's lower by more than 50%. Big step back. The problems for this industry right now, the winners seem to be specializing in one thing. Either you design the chips or you make them. The people who are struggling, the Intels of this world, are trying to do everything. Why is that turning out to be so difficult?
I mean, Intel as an entity was too big to turn around to begin with. And we have a history of, you know, tech turnarounds are far and few when you think about, you know, Microsoft being the most successful turnaround. And the reason why they were so successful is because they anchored on one thing, cloud. I mean, they even gave up on the operating system. They didn't really invest on the operating system that much. In the case of Intel, the foundry turnaround was the hard part. I think the Achilles heel for Pat Gelsinger was he kept throwing money on foundry when TSMC was way ahead in terms of, you know, that aggressive strategy around 5 nodes in 4 years. I mean, that was so unrealistic to begin with. So that's where focusing on the design side, I think, would have been the right approach. And we have a precedent, AMD being so successful because they spun off Global Foundries, the foundry side. And then look at how far they have come when it comes to the design side.
How much are Intel's hands tied, for regardless of who comes in, because of the government contracts, specifically tied to the presence as a foundry?
So I think the foundry side for Intel, look, they have been the recipient of the CHIPS Act. They have been getting money from the government in terms of turning that around. And in the case of Intel, they have an install base for x86, which is really the core architecture that's still being run on PCs. On the data center side, obviously, they have lost a lot of share to NVIDIA. But I think the government is in favor of local manufacturing, and that is supportive of Intel as a company, for sure.
I guess the larger question is, what should they be focusing on, and what should they get rid of?
See, the problem is the foundry side is a very low-margin business. Because it requires such heavy upfront CapEx, you're never going to get to that mid-70% gross margin like TSMC for at least the next 5 to 7 years. On the design side, they do have a PC refresh cycle that's coming up. And if this AI wave is really secular, 10, 15 years, then people will upgrade PCs. And that's where Intel is still the dominant architecture. There is no NVIDIA. They are losing some share to AMD, but for the most part, it's still Intel. And that's where they can generate a ton of free cash flow. So I would say anybody stepping in now and coming in from outside or inside, I can't really guess, would be focusing more on that PC client-side opportunity.
So Mandeep, big changes, big challenges for them. What's the first thing they need to do?
Make a strategic decision. They actually tried to acquire Power Semis, which is another foundry company. That never went through because of regulatory hurdles. So clear on strategy. They have 3 rounds of layoffs. Nobody does that. If you're trying to turn around, you cut deep enough once. You don't try to do 3 rounds of layoffs. So I think setting that strategy would be paramount.
They're searching for a successor. Does it need to come outside of the company, given some of the things you've just said?
I mean, if it's from the design side, they should better get someone from NVIDIA, right? So, or if they're doubling down on foundry, then get somebody from TSMC. Those are the 2 clear leaders. So I think it makes sense to get somebody from one of those 2 companies.
Mandeep, it's good to see you. Appreciate it. Mandeep Singh there of Bloomberg Intelligence on the latest news from Intel. That stock is higher by a little more than 4%. No doubt Matt, Katie and Shanali will be picking up with this story in their A blog in about 5 minutes' time, Bramo. That's the stock to watch into the opening bell.
You asked the question, does it have to come from outside the company? The new co-CEOs, at least temporarily, are David Zinsser and Michelle Holdhouse. Zinsser was formerly the CEO of Micron, so it gives you some sort of sense of where the minds are at.
Coming up tomorrow on the programme, we'll continue the conversation with Ken Tropen of Graham Capital Management, Libby Cantrell of PIMCO, Tony Rodriguez of Nuveen, and David Rogel of BlackRock. From New York City, thank you for choosing Bloomberg TV. Welcome back to work for many of you. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number 1 lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Coming up, Pat Gelsinger retires instantly as Intel CEO after a storied career. Well, it was some story to the downside. The company he's leaving lost 50% of its value in the last 5 years. We'll have the latest on the new interim co-CEOs. Co-CEOs are always a great idea. Trouble under the hood. The Stellantis CEO also resigns unexpectedly as Volkswagen workers across Germany stage walkouts over the automaker's plan to cut costs. So a lot to talk about in the car space today. And most Black Friday shoppers bag their deals online. We'll ring up the latest trends as Cyber Monday comes on strong. First off, let's take a look at these markets. Fairly calm after a positive November. We had back-to-back monthly gains, and we're kicking off December with very little movement in terms of futures. On the S&P, we're up 3/100ths of 1%. NASDAQ futures up 0.2 of 1%. And the 10-year yield right now rising 5-6 basis points to 4.22, 4.23. Shonali, what are you looking at in terms of stocks?
A lot of calm over there. People still rolling back from their holiday weekends here. But of course, some companies rolling back strong. Gap being one of them, 4.6% higher pre-market. It's getting a boost after JP Morgan upgraded its rating on the apparel retailer. But then we're watching Stellantis falling more than 6.4%. Their CEO unexpectedly stepped down. Stock taking a hit on that news. We'll talk more about it later in the show. Intel, as we've been talking about, jumping on the news that Pat Gelsinger is retiring as CEO, now up more than 4%, Matt.
All right, we're going to continue on that story right now. Joining us to talk more about it is Mandeep Singh of Bloomberg Intelligence. Mandeep, Pat Gelsinger retires effective immediately. The company has, I guess, no succession plan, so they put in 2 interim CEOs. Why?
Well, I mean, look, the turnaround clearly didn't play out the way he expected or the strategy that he laid out. And in this case, they're probably going to look for somebody externally to come in. Pat also came from outside, by the way. But clearly, he tried to take too much on in terms of turning around both the design side and the foundry side. And in this case, my bet would be anyone coming in is going to pick a side. Is Intel going to be a chip design company or a foundry company? I think turning around the ship as is with both the parts is very hard. That's what we've figured out.
How necessary was it to find a new CEO at this point in time? The fact that not only did they name interim CEOs, he's stepping down, as you said, imminently. Was it necessary to have new leadership in the middle of what's already a drastic turnaround story?
Well, so look at what has happened operationally with Intel. They've had a couple of rounds of layoffs, and the direction that Pat had laid out, not picking the side, as I said, has made it very hard for investors to gauge, is this company going to turn around even in the medium term? Because everyone anticipates a big PC upgrade cycle. Even though Intel is losing share on the data center side, the PC side, Intel is still dominating, and they are the incumbent player. So not participating in a PC refresh cycle will be a very big deal for a company like Intel. And I'm guessing the board didn't have enough confidence in Pat's strategy. So that's what it comes
Not
down.
even enough confidence to leave him there for, say, a month while they find a new CEO to replace him full time. They had to have him out instantly and replace him with co-CEOs. What does this mean for the billions of dollars of government funding Intel is earmarked to get?
I mean, they'll still keep getting it because when you look at the precedent we have with AMD actually divested their foundry business into global foundries, and they became, a design company. I expect something similar to happen with Intel because the government wants chip manufacturing to stay in the U.S. So if the foundry business were to be divested, then they would continue to get funding because
as a designer?
As a manufacturer like TSMC.
So the foundries that they divest would continue to get the funding.
Yeah, and then on the chip design side, as I said, the PC business is still very healthy. It's going to generate its own free cash flow, so that may sustain on its own. So it comes down to whether foundry gets divested or not. And
on this breaking news, it was only about a half an hour ago, Mandeep Singh of Bloomberg Intelligence. And joining us now on the broader markets, we're going to speak with Stuart Kaiser. He's head of U.S. equity trading strategy at Citigroup. And from what I understand, you're excited to shift gears here. There's payrolls on Friday. Market will quickly be shifting over to that. What are your expectations?
Yeah, I mean, the way the data is forecast to come out, it should be very positive for equities. I mean, consensus is about 200K on payrolls, still about a 2/3 chance that the Fed's going to cut on the 18th. So you put all that together, it does stack up pretty well for equities into year end, and I do think markets will take a little bit of a breather here from all the political headlines, hopefully just for a week or two.
We've already come so far so fast, right? I mean, we're up, what, 26% year to date on the S&P, second year in a row with more than 20% gains. Do we advance significantly into year end? Does the January effect give us a significant boost, or what do you expect?
Yeah, I mean, I think our view is that you will rally into year end. Typically, you know, early in the calendar year, you get kind of these rotations and things like that. So I think a lot of people are continuing to look at small cap as a little bit of a catch-up trade. You have very strong seasonality there. In addition, you have obviously kind of a Trump impulse going through the system as well. So yeah, we expect markets to rally into year end. We expect small cap to do well. I think as you look into 2025, it's hard obviously to envision another 25% year, 3 in a row. And I think the two reasons for that are probably valuation, A, does look a little extended, and then B, the earnings bogey for 2025 is relatively high for the S&P as well. So you are entering the year next year with a pretty high bar to begin with. So I think a lot of folks are looking at where there's S&P equal weight, where there's S&P small cap, Russell 2000 as potential catch-up trades early next year.
By the way, it does seem like we're only focused on the good parts of Trump 2.0 and not, I mean, like, we care about the tax cuts and deregulation, so we're rallying. And if someone mentions like mass deportations and tariffs, they say, that's just negotiation.
Yeah, I mean, I think that's right. Like, there's been 3 kind of primary election trades, I think. One is M&A targets. Those have been beneficiaries. The second is government spending. Those are more on the victim side. So I think that would be kind of the negative side of the Trump trade right now. And then you have this domestic versus foreign kind of imbalance going on. So domestic sales companies outperforming those international. So, you know, I agree with you. I think, you know, our view is election has 3 stages. You had the initial reaction, which was about sentiment. Now you're in kind of the policy proposal phase. Next year is going to be about implementation. And I think a lot of what you're talking about, those risks are really going to be activated once you actually start to see these policies get implemented. So we'll be eagerly awaiting that for 2025.
Stuart, hang on tight really quickly because I want to bring some more breaking news over. Supermicro is replacing its CFO, David Wygand. Remember, Supermicro has been under a lot of pressure, has short selling, regulatory investigations here, and you are seeing the shares jump 11% pre-market, Matt. So I wanted to point that out as well because it's been a story that we've been watching. Yeah, of course, a lot of executive changes on this Monday morning.
Executive changes and massive volatility continues for this name, right? SMCI is the ticker. They lost their... They lost EY, I think, and then replaced them with another auditor. And that caused double-digit drops, then double-digit gains, and now we see another pre-market double-digit gain on another CEO shift. So interesting story, yeah.
Into the market. But Stuart, back to the broader markets because there's another Trump trade. That's what we were talking about. And one was the Russell 2000. You had mentioned potential room for upside. It just had its best month since the end of 2023. I mean, it was up more than 11% last month. How much more does it really have to run?
You know, I think people are girding up for a really positive seasonal. 30 out of the last 38 years, you've had Russell 2000 up in December by an average of about 2.5%. So I think you have a seasonal impulse, you have a deregulation / growth impulse from Trump, and then, as I alluded to, you also have kind of this M&A story out there. And I think all 3 of those are incrementally positive for Russell 2000. So I think at least into year end and potentially into early next year, as you get these kind of, you know, rotations around calendar year end, we do think, you know, Russell has some legs behind it.
It's amazing. I mean, more than 10% in 1 month. for the Russell, right? The S&P for the month up 1%. So massive, massive shift. And it makes me question, do we continue to see this rally in the S&P, or does this broadening out take some wind out of the sails of the mega cap stocks as, you know, it drives other places in the market like small and mid caps?
I mean, our view is to have that rotation working, you need S&P 500 higher. So S&P, I think returns are positive. Obviously, it is underperforming and should continue to underperform, consistent with how its kind of beta lines up. But our view is it's very hard to rotate into small cap, lower quality stocks at a time when markets are pulling back. So I actually think the rotation into small cap is almost conditional on the fact that you get S&P 500 higher.
So one thing you mentioned earlier is contingent on that Fed rate cut in December. Right now, market's pricing in a 62% chance. If you don't get it, what's the downside risk?
I mean, if you don't get it, I think that probably means you printed a really, really strong jobs report. So in that sense, I think equities are probably net still higher on that. Like, I'd much rather have a strong labor market with the Fed cuts being pushed out, which is frankly the thing we saw in the first half of this year anyway. So like, I think for the Fed to skip, that's telling you economic data is very, very strong, and I think equities can kind of rally through that. You know, the Uber bull case is you get, call it 150 to 200K jobs. The Fed wants to get some cuts locked in ahead of potential risks like tariffs next year, and that should push equity markets higher. So if they skip, I think it's actually for good reasons in this case.
A lot of bullishness. Either way, walking into December, that is, of course, the Stuart Kaiser of Citigroup. We're now going to take a quick check on futures here as well, because equally bullish, not as bullish, though. You're watching the NASDAQ 100 futures up about 0.2%. Russell 2000 futures taking a little bit of a breather, roughly flat, and so is the S&P 500. But of course, that was after a strong November. We're going to get a look at some of the stocks moving ahead of the opening bell. Bring in Abigail Doolittle.
And beneath the surface, Shonali, we do certainly have some bigger movers than that relatively flat surface. Starting off with the shares of Tesla, this stock has been in a major rally move out of the April lows, apart a piece of that Trump trade. Today up nearly 2%. This says Roth MKM has upgraded shares to a buy. The analyst there saying that he believes that there's going to be a new pool of enthusiasts for Tesla vehicles. In addition, that the sunsetting credits, EV credits, could hurt the competitors. Additionally, Stiefel has raised their price target to a street high of $411. Turning to the shares of Block, this stock is also higher, right now up 3.4%. Bernstein is calling it a best new idea, saying that there's lots of catalysts for the stock. Separately, Goldman Sachs has raised their price target by about 10%, more than 10%, to $102 per share, suggesting there could be more upside potential. And then finally, rounding it out, the shares of Intel, today's big stock story. We do have them up about 3.9% off the highs on the news, of course, that CEO Pat Gelsinger is stepping down, retiring, the turnaround not gaining the steam that many had hoped. The stock on those failed turnaround hopes right now down more than 50%, although I will add, Matt, at the lows, it had been down closer to 60%. So off of the lows, but nonetheless, CEO Pat Gelsinger stepping down.
All right, fascinating day for CEOs and CFOs. Abigail Doolittle, of course, the CFO of Supermicro, also out, as well as the CEO of Stellantis. So a lot of shifts in the C-suite. Coming up, President Biden, speaking of shifts, taking his son Hunter off the hook. He promised he wouldn't do it. He wouldn't interfere in the U.S. judicial system. And then he does just that with a presidential pardon. That's next. This is Bloomberg.
In global leadership are on Bloomberg.
We need to do the green transition together. Let me simplify. Europe emits about 5% of all the world's CO2. The United States emits about 15%. China emits around 30%. So it's important that we find the technological and trade means to deal with this together between Europe and the United States. And China needs to pay too.
Nobody covers the top global leaders like Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Tensions on the rise in Syria as Islamist rebel fighters advance south after capturing much of Aleppo again. It's the most serious challenge to President Bashar al-Assad in years since the country's civil war began over 10 years ago. Government forces, which are backed by Russia and Iran, appear to have withdrawn from some areas and are now bombing the rebels in Aleppo. In France, the government offered a last-minute budget concession to avoid being ousted from power in a no-confidence vote. French assets bounced back from some pressure on the news, but the Feta-Brie spread remains tight as investors punish the political uncertainty emanating from the country. You almost pay more to borrow from the Greeks than you do from the French. And Canada is set to beef up its border enforcement in a visible and muscular way, according to top Canadian officials. The pledge comes after Prime Minister Justin Trudeau went to Mar-a-Lago to dine with President-elect Donald Trump after Trump promised to impose a 25% tariff on imports from Canada into the U.S. due to the movement of fentanyl and unauthorized migration. Shanali?
Now we're going to stay on politics. We're going to talk about how President Biden announced that he's pardoning his son Hunter after previously saying that he would not use his executive powers to help him. The president wrote in a statement, quote, "I believe in the justice system, but as I have wrestled with this, I also believe raw politics has infected this process, and it led to a miscarriage of justice." For more on Hunter Biden's pardon, we are joined by Bloomberg's Julie Fine. Explain the fallout since the announcement.
Well, I think this is fallout that he obviously expected. When you do something like this, after saying several times, I'm not going to do this, and then you've got the video also of his press secretary saying over and over, he's not going to pardon his son, you have to be aware that there's going to be fallout. However, I think he made this decision that he feels, like he said, this was a miscarriage of justice. He's out in 2 months. He makes the decision when he's about to leave to go overseas, decides to do it, takes off on the trip.
Yeah, I mean, I think it's understandable as a father, right? But if you're trying to set an example for the country and be as un-Trump as possible, it doesn't make sense to be so Trump, right?
Again, I think he just hit this point that he is like, I am done. He has a party that basically said, listen, we don't want you to run for president. So at this point, he's like, I'm leaving in 2 months. I want to protect my son from what he feels is not fair. He also, by the way, this is a blanket pardon. This isn't just for
anything he's done over the past decade.
Now, there is some type of precedent. I mean, you do have to remember that President Trump did pardon his son-in-law's father. Bill Clinton, let's go way back in the day. I'm old enough to remember when he pardoned his half-brother.
And Mark Rich.
Right, so there is precedent for this. There is precedent, however...
Not good precedent, though.
Well, this difference is here. He said he wasn't going to do it. And there's plenty of evidence saying he's going to have to do it. Now Democrats who are trying to figure out, okay, what's our message? What's next for us? Who's our leader? They're all going to be answering questions about it. And I think Democrats have learned that this party has to be, we're not Donald Trump. So you can't just respond to this by saying, look at what President Trump did. You've got to come up with your own messaging on this when Democrats are just trying to come up with their message, period.
And you mentioned his son-in-law's father. We should say Charles Kushner was not only pardoned, he was recently also tapped to be the ambassador to France. I want to switch gears just a little bit here because another big story of the day, also big take of the day, tariff strategy here. Bloomberg Economics really talking about essentially a tripling of what we see over the next few years, especially when it comes to China alone. I mean, how are politicians preparing for this, especially knowing that their local regions might experience some more inflation over time? How are business leaders?
Well, first of all, I live in Texas where they really have to prepare for tariffs due to the fact of trade, coming over the border. This is how I think everybody's preparing. Let's wait and see if he really does it. Like you've got Justin Trudeau flying to Florida this weekend, going to Mar-a-Lago. Clearly he is concerned about this. You have him on the phone with Mexican President Claudia Sheinbaum. I mean, I think what they're preparing for is to see what he actually does, if this is a true threat or if this is going to happen, and definitely having these preliminary conversations, building up the relationship, because look, I mean, the man has an enormous amount of power right now. He won all the swing states. I mean, he can say what he wants and do what he wants. Now, of course, you have a Congress as well that's certainly going to have something to do with this, but I think the preparation really now is this going to happen? Let's try to make sure that it doesn't and prepare for it at the same time.
Did you see the picture, Matt?
Which picture?
The Trudeau picture at
yes.
Mar-a-Lago?
Yeah, I did.
Right.
By the way, I was in Florida this past weekend, a very unexpected trip. And, he pops up there on a Friday night. And from what I'm told, so unexpected that, hoteling was an issue.
David McCormick, Dina Powell, all at the table as well.
Right. So they're there. And, I mean, he's smiling and looking as happy as he can be because he needs to be smiling with President Trump to get President Trump to think, okay, we have to work together. We can't blow up these massive trade agreements, which he's saying that he's going to do. So if you're somebody like Trudeau, you're going there and saying, I want to get in early. I want to get in good. I'm going to say, maybe he'll say what he wants to say and do it quietly. But the bottom line is he knows that President Trump pays attention to the news and what's said. So that picture of him smiling may put him in a better position.
A lot of activity at the Winter White House.
Yeah, absolutely. And it makes sense, It's probably a nice place to be as well. Julie, thanks very much. Julie Fine there covers politics for us, typically out of Dallas, although she is sometimes in Florida as well. We're going to continue to talk about these markets going into December. That's next. This is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning from our world headquarters
News in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, quick check on futures. You can see little movement in terms of S&P futures, NASDAQ futures, and Russell 2000 futures are higher. But it's really under the hood where we see all the action. Shanali, so many C-suite changes. Yesterday, I logged on to the Bloomberg to see that the CEO of Stellantis is stepping down. He was supposed to stay until 2026. This morning, we get a headline that Intel CEO is going to retire, replaced by interim co-CEOs. And then Supermicro replaces its CFO, but said they found no wrongdoing in an internal investigation.
Yeah, that internal investigation is a big deal, but also it's interesting to see the stocks react so differently. Intel really getting a boost here from that announcement that Pat Gelsinger would step down immediately. Not so much for Stellantis.
Yeah, Supermicro also getting a big boost. Right now at 15% is obviously a much more volatile stock, but Stellantis down 7.5%, I think on concern that it just takes so long to introduce new products, and that's one of the big problems here. And Carlos Tavares was seen as, you know, the new Carlos Ghosn here, but he wasn't able to deliver. So they need to find a successor other than Johnny Elkann.
Yeah, we've written that also. Dealers have said that he's kind of ruined the Jeep brand. Can you believe I know something about cars?
You know a lot more than you give in about cars. Jeep has been a problem, but Chrysler obviously only makes, I think, one product now, which is a minivan. Dodge has been limited now to only a couple of products. No, it's not good. They don't have anything on lots there, and that's a real problem. We're going to continue to talk about this and also tell you more about the chip story with Intel replacing Pat Gelsinger. The opening bell in less than 4 minutes' time. We're going to talk to Katrina Dudley at Franklin Templeton. This is Bloomberg.
politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're not seeing a lot of action in futures this morning. S&P futures now up just about 0.06%. You're seeing bigger gains in NASDAQ and Russell futures, but also not by much. It's really a story of CEO shifts today. The CEO of Stellantis, Carlos Tavares, is out. The CEO of Intel, Pat Gelsinger, is out. And over at Supermicro Computer, a much smaller company, but they're losing their CFO, although they did an internal investigation that found no evidence of misconduct. In terms of the opening bell, I think we had Scholastic ringing the opening bell at the NASDAQ. I saw it only very briefly, and now it's gone. I didn't even see the NYSE, so maybe nobody rang the opening bell there, but we do have the markets open right now. We're looking at the live trade, and you can see that the gains are similar to what we saw with futures. In terms of stocks to watch, Stellantis is my focus this morning, falling after the company's CEO unexpectedly stepped down or was pushed out. It was a board meeting, so we're not sure exactly how that happened, but the stock is down 7%. It leaves the car maker without leadership during a critical time for the industry, although it should be mentioned that Johnny Elkann is the chairman of the board, and he has a ton of experience, not only with Carlos, but also with Sergio before him. So I'd say they're in pretty decent hands, at least in terms of interim work. Shanali, you're watching The Gap. What's going on there?
I know that your daughters may still be too young to be hanging out in ripped jeans, but but Gap here, of course, other people are buying them. You have it up now almost 5% as the market opens. It is getting a boost after JP Morgan upgraded the rating on the retailer, saying that the foundation has been set to support a consistent playbook of improved merchandising and marketing. And the big story of the day, we're taking a look at Intel. It's rising after the chip maker announced the retirement of Pat Gelsinger as CEO. Intel now up about 3.6% as the market opens now.
All right, we'll continue to pay attention to those and those big movers on the day. I want to take a deeper dive, though, into Pat Gelsinger's retirement. It's being called retirement. We're joined now by Bloomberg Technology co-host Carolyn Hyde. Seems a little abrupt, Carolyn, for a retirement. And they didn't even have a replacement ready, just interim co-CEOs. What's the story here?
And they seem to be elevating Michelle Johnson Holthaus, who is known as MJ, into a CEO of product role at the same time as giving her this interim role alongside the CFO. Whether or not it's abrupt in terms of a decision to step down from Pat Gelsinger, the slow burn on Intel has not been abrupt. We're down 60%, let's call it, in terms of share price this year. Pat had a particularly painful set of numbers in August that really sent record share drop on the back of ever more evidence that this company is falling behind. Just think, 60% down in his tenure for Intel, whereas NVIDIA's up 800% in his tenure since 2021. And even AMD has done particularly well since he took over in 2021. So this has been a painful leadership trajectory as he's tried to reorientate, get back into the fabrication side of the business, which of course they had to put on ice when they were building out the manufacturing area in Europe in particular.
And I'm sure investors are very soon going to become much more antsy to actually get that more permanent replacement. In the meantime, what do we know about the interim co-CEOs? Matt was joking, always a good idea to put 2 people in charge.
It's never a good idea, and yet boards do it all the time.
And we don't know how much this is going to be on an interim basis with these 2 internal candidates, or how much they then go to look externally. Remember, Pat Gelsinger himself was long-term Intel. 1980s he came on. He was like key to the fabrication of certain microprocessors and building of them at Intel. He then became the CTO, left to VMware, which was, of course, combined from EMC. Then he came back again. When you're looking at MJ and when you're looking at David, the CFO, look, these are 2 long-term executives. These are people who perhaps, when they're giving MJ in particular a upgraded role to the head of product, and within the statement they put out today, they say the product needs to be back at the heart of what they're doing within the business. Maybe that's trying to signal something about her long-term trajectory here. But more broadly, I think it is trying to get their arms around what the strategy is. Is this a company that they're going to start breaking apart and selling off to others? Now, remember, we've had reports that ARM, Qualcomm have been interested in this company. We already had a big returnaround proposition coming from Pat saying that the foundry business will be spun off. It will ensure that they'll keep it but different operating board more broadly. They want to be manufacturing and designing. They need to keep up with the likes of TSMC. They need to get Gaudi in there. Remember, this is the AI accelerator part of the business that is likely to miss $500 million target for this year. When NVIDIA's bringing in $100 billion a year, when AMD is bringing in $5 billion a year, this is the future of chip making. They need to start showing some precision there, and Michelle Johnston in particular, is the person who is leading the AI push.
Yeah, sounds like the downfall of an American icon kind of wrapped up here. Caroline Hyde, thanks so much for joining us. She is the co-host of Bloomberg Technology. You can see her show at 11 a.m., and I'm pretty sure they'll probably focus on this issue as well. Right now, let's talk broader markets with Katrina Dudley, Franklin Templeton Public Markets Senior Investment Strategist. Katrina, a lot of CEO shifts today, but not a lot of movement on the index level. Do you have any thoughts, first of all, on American business icons that are flailing?
I think it's so interesting to sit here and for us to say they failed and they're flailing and everything, and to kind of judge from the outside. I think realistically, you need to be an insider to get that real look into.
Well, if you're an investor, you definitely feel the pain, whether or not you know what's going on inside or not.
Exactly.
Right? Your stock's down half over the last 3 years, and the market has tripled.
Exactly. But the thing about CEO changes is they can be a signal of, yes, there was bad things that happened, and that often is the accelerant that causes the change, and it reinvigorates people's desire to continue to change, because change happens when people take action. And so I actually look at some of these CEO changes as a positive thing. However, if you have a look back, we have seen over decades a number of companies in the industrial space where you've had a CEO change. You've had even some really well-known brand name CEOs come into a space, and the stock still takes another leg down while they assess the company, they assess what's wrong, and they put in place their plan. And investors during that kind of information vacuum, they don't have anything to kind of sink their teeth into. And so I would expect that you could see in certain of these situations further weakness.
Something I find really interesting today is not only do you see Intel up almost 3%, you actually see most of the Philadelphia Semiconductor Index up, and you see Taiwan Semiconductor ADRs and Marvell up even more. And you think about the posturing that the U.S. has to the chips industry and the way that they're looking to tighten curbs on how China accesses AI memory chips. What does this mean for the industry, particularly in the United States? With the big AI bet that's going on, do you double down?
So isn't it interesting? We've been talking about Trump and tariffs and what's going to happen, and it's actually the Biden administration in their final days that are doing these actions in terms of further curbs on China and further protection of the U.S.'s intellectual property. And I think that that's the key message I'm taking away from this, is that the U.S. is finally kind of backing with its might and saying, you cannot take. And that's a very positive message. Why is it so positive? Because it sends a signal to people that we will protect assets that were developed here by our companies, and we will enforce the rules and the rule of law. So I think as you look at AI and you look at companies, AI is such a long-term investment. It's a lot of upfront capital. You're getting a very clear message that we will protect that investment and your right to earn a return on that investment. And that's what we want to see as investors in these companies. So it's positive.
Does that AI optimism, or at least expectation of massive capital expenditures, boost your outlook for the broader market? I mean...
Yeah, it's interesting. AI, from our perspective, has really interestingly 3 aspects to it. The first is as we look at companies and the productivity. So you look at Bloomberg, you look at Bloomberg Automation, for example, and the productivity they're generating. The second, as we look at investing in companies, you mentioned a number of the beneficiaries. NVIDIA is obviously the poster child for that, but we have it from investee companies where we put our capital. And then finally, from our point of view as a company, we have AI opportunities in terms of making our sales force, meeting our clients' needs and becoming more efficient. So the AI story to me is not this one-dimensional investment. It has the CapEx side, it has the productivity side, it has the investee side. So there's just so many dimensions to it, which means there's a lot of opportunity.
I'm glad you mentioned Bloomberg Automation. The other day, Ken Griffin asked me what I use it for, and I love somebody else, a robot, reading my 13 Fs for me, is what I said.
Good point.
And, one thing I'm really obsessed about, you mentioned tariff strategy. You have Bloomberg Economics predicting that the tariffs will be implementing in 3 waves. It'll start in the summer of next year, and that it would be a tripling of levies on China by the end of 2026, smaller hike on the rest of the world. The bigger issue, I think, is imports and exports dropping to 18% of the global total from 21%. That is meaningful.
Yes.
And what does that mean in terms of American economic growth?
I think anyone who can put a definitive date on when these tariffs are going to be implemented deserves a pat on the back, because I think that we're looking at the information we're receiving. There's so much uncertainty here. We're not sure if it's just posturing. We now have Bessent, who's in his role. We think he's likely to temper some of these because of the economic impact. If I have a look, yes, there is going to be some level of negative impact in terms of the consumer, the pressure. But companies have got time. You're talking end of 2026. That is over 2 years for companies to prepare. Our companies are nimble, our companies are quick, and they're adaptive. So I would actually take the other side here. I would actually say, yes, I can make you the negative case, but I'm going to bet on America, and I'm going to bet on the fact that we're going to adapt.
A lot of bullishness this
I like it.
Yeah.
Katrina, happy December. Thanks so much for joining us. Katrina Dudley there of Franklin Templeton. Coming up, Stellantis shares are under pressure after the CEO's surprise resignation. More on the auto sector next. There's a lot going on, including Volkswagen strikes in Germany. This is Bloomberg.
In case you missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies, where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, the fact that if you can do it, you're one of a few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Every everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. Right now, you can see that the gains are minimal at the index level, just about 0.1% on the S&P. The NASDAQ doing far better, up about 0.6% as we see gains in stocks like Intel and Supermicro Computer shifting out their leadership. In terms of the Russell 2000, you do see a little bit of a drop here, about 0.1%. It's time for our top calls now. Some of the analyst action in focus this morning. And first up is Gap, getting upgraded to a buy at JP Morgan after the firm met with the company's CEO and CFO. The analyst sees Gap at an inflection point that will support sales growth. And next up, Morgan Stanley says it is treading more carefully on cybersecurity stocks. The firm is downgrading SentinelOne, saying it's no longer a buy. The analyst says the incoming Trump administration could propose significant budget cuts, and that could be a major headwind to cybersecurity. Finally, Toast is getting downgraded by Goldman. The firm says the restaurant software company is no longer a buy, citing elevated valuations and limited visibility. And Stellantis has been a focus this morning. The shares under pressure after CEO Carlos Tavares steps down. He had a dispute apparently with the board over how to reverse the car maker's weakening sales and stock slump. For more, Bloomberg's Oliver Crook joins us out of Berlin. And Oliver, this all came to light after a board meeting yesterday. What exactly happened?
Yeah, exactly, Matt. I mean, listen, this really began, I think, back in September when Stellantis put out that profit warning, which really caught the market off guard, and I would say really has been sort of staggering forward ever since that happened. At the time, Tavares basically tried to quash any sort of discussions around the fact that they might be time to replace him. He said he was certainly going to see out his contract until the beginning of 2026, and at the time, he said a management massive shakeup. He replaced the CFO, the COO in North America, the heads of Maserati, as well as Alfa Romeo, to really quash any discussion about him stepping out early. And he had basically the unanimous support of the board, and that changed over the weekend on Sunday with this sort of sudden bowing out, basically, of walking away from the car maker. And Matt, as you know, this is pretty huge for the European car sector. Tavares has been there since the inception, the beginning of Stellantis. The combination between PSA, Peugeot Citroën, and FCA, Fiat Chrysler back in 2021, and really a legend within this sort of sector. Really, he had been focusing on the cost cuts across the board, cutting very deeply. That is part of the sort of criticism that he's got from a number of the dealers, but also the unions, that maybe he cut a little too far, and some of that sort of being evident in some of the quality controls and some of the cars that we're seeing out of the United States.
Quality control, Ollie, and also brand damage. That was the criticism you got from dealers here in the United States: Jeep, Dodge, Ram, and Chrysler. And so if you look to a potential new CEO, reporting that you might not have one until the first half of next year at some point, how big of a hurdle is there to turn those brands around? How long would it take?
Yeah, I mean, listen, this is the question for not just Stellantis. This is a question for the auto sector in general in the United States and in Europe. And this is really not the time to be without a leader, I think, in the European automotive sector, any automotive sector, right? And Stellantis really had been doing comparatively really quite well compared to a lot of the European brands, particularly earlier in this year. And really that has all basically evaporated. The stock is down 45%. It is now the worst performer of all the European auto sector going into closing out this year. And again, this is really not the moment to be without a sort of clear vision for what you're going to do with this brand and the many, many brands within the portfolio. This is part of the issue that we're having across the industry. There are a ton of brands. They're getting more and more crowded because you have more and more Chinese automakers, particularly in EVs, out-competing these European brands. And the answer is no one yet really has an answer yet, but everybody is trying, and everybody increasingly is trying to cut more and more costs. I think part of the concern with Stellantis is they've already cut so much of the cost that that bullet might have already been fired.
Yeah, I'm looking at the websites now, right? Dodge they still list the 2023 Challenger and Charger as products. They don't even make them anymore. In terms of Jeep, they have a Jeep Wrangler that costs over $100,000. That's pretty ridiculous. Ram Trucks doesn't even make a V8. I mean, they just seem to have given up. They need someone who can bring back some product.
And this is part of the criticism, right, is that there just is not enough product. There is a sort of endless number of brands, but there are not these new models that are coming forward to market. And that has been a big complaint from the dealers. It has been a big complaint from a lot of the consumers. You know, not everybody has the good taste, Matt Miller, to buy a Dodge Challenger V8, though perhaps they would be benefited from doing so.
Yeah, I highly recommend it. Go out and get a used one. Oliver Crook in Berlin, thanks very much for joining us. I want to quickly bring you some breaking news on France. The Prime Minister there, Michel Barnier, used a constitutional tool to push through parts of his unpopular budget bill without a parliamentary vote, raising the prospect lawmakers could dissolve his government within a matter of days. So the disaster continues there. Coming up, JP Morgan rejecting a popular Wall Street trend. We'll take a look at why in today's Wall Street Beat. I'll give you a hint. It's ESG and it's unpopular.
Energy transition.
This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick look at what's going on with stocks. Just about 20 minutes into the trading session, you can see the S&P 500 gaining 0.1%. The NASDAQ up a lot more as Intel and Supermicro gain after ousting some of their executives. Russell 2000 stocks, though, down about 1/3%.
But after a very strong November, as we've been talking about, but we're going to switch gears, Matt. We're going to go to the Wall Street Beat. Today, we're looking at why JP Morgan is rejecting a new Wall Street trend. For more, we are joined by Bloomberg's Alistair Marsh, and you make this point in the story. JP Morgan is really bucking the trend here in transition finance. This is all, you know, when it comes down to the energy transition, but Apollo, a big client, sees a $50 trillion opportunity over the next couple of decades. This is why other banks have been getting involved. Do you think other banks will start to go the route of JP Morgan, given the returns you've seen in renewable?
Hi, well, good morning. So what JP Morgan is actually saying is that they're not rejecting the idea of an energy transition. They sort of support or endorse the thesis that there is money to be made from financing companies that are decarbonizing. But what they're saying is that they themselves are not going to create some sort of framework, you know, the whole ESG establishment so far, the whole architecture is built around frameworks and taxonomies, and is this a green asset, is this a brown asset? And they're saying that in some ways, who cares about that? What's really important is, are we financing, not just do we have transition finance, but are we financing the transition of real economy companies? And so that's sort of their focus. It's not that they deny there's an opportunity, as Apollo have said, it's more that they think we don't need any more taxonomies or frameworks. We're kind of taxonomied out. Leave us alone with the box to tick. We just need to get to the real action of financing kind of corporates who want to decarbonize. That's what they're saying.
I mean, it seems like the opportunity is one to lose money, Alistair. I look at, the S&P Global Clean Energy Index that you highlight in the story, and it's just gone down. I love the Linda French comments about we don't care about taxonomies. It doesn't matter what you label it, green or ESG or whatever. We're only going to invest in something that's financially viable.
Exactly. I mean, the high point of ESG was a couple of years ago when everyone was committing to net zero, was saying we're ready. But then what happened was just a few months after that, you had Putin invade Ukraine, you had energy prices go through the roof, and you had all these fossil fuel companies that banks and investors had talked about withdrawing from. Those were suddenly very profitable clients, and that totally changed the calculus on the energy transition and how banks should be involved in it. And you're right, the clean energy companies and clean energy stocks have been obliterated in the last sort of 2 years. And that has really pulled the rug out from underneath all of those who are championing this notion of we need to have an energy transition. Banks are pushing back and saying, yeah, fine, we'll endorse it, we'll support it, but only insofar as it delivers returns for our shareholders.
Alistair,
let's not forget we are...
We have just a couple, 30 seconds or so left here. There's an amazing chart in this story as well that shows just how much power grids have been an increasing part of the story in the last 3 years. Is this all AI? Has the narrative changed around the energy transition?
Well, the AI really complicates the energy transition because the energy usage, as you know and have spoken about many times, is enormous, is vast. But at the same time, the companies that are really building out these data centers, the Microsoft and so on, are the guys that are actually the most committed and have done the most when it comes to building out and sourcing renewable power. So it's sort of a double-edged sword, and the jury's out as to whether AI will be beneficial to the energy transition or not yet. Certainly, it's creating a lot of money flow towards renewables, but there may come a point where we're having to run energy centers on fossil fuels too.
Well, it is a fantastic story, Alistair, and I love the visuals in it as well. Highly recommend that people check it out on Bloomberg.com or on the Bloomberg terminal. Alistair Marsh there penned the story, JP Morgan rejects transition finance trend gripping Wall Street. Coming up, we're going to talk to Liz Ann Saunders from Charles Schwab. This is Bloomberg.
Stefana. I am the owner of the family office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so anybody, we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will publish. I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week, from morning to night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Hunter Biden won't be going to jail on his felony gun or tax convictions. His father, the president, has reversed a long-standing pledge and pardoned his son. Correspondent Ed O'Keefe with the elder Biden statement.
No reasonable person who looks at the facts of Hunter's case can reach any other conclusion than Hunter was singled out only because he is my son, and that is wrong.
CBS News legal contributor Rebecca Royfe.
There is no direct proof that the Department of Justice acted in a politicized way. And by saying that, by making that allegation without proof, he does significant damage to the integrity and independence of the Department of Justice.
Mr. Biden made the announcement before he left for an official visit to Angola last night. Lots of holiday travelers flew to their Thanksgiving destinations. The TSA says it screened 3.08 million passengers yesterday. That's the highest number ever for a single day. Wintry weather is making travel more difficult for people who live in states bordering the Great Lakes. Kelly Merritt had to be creative to get her car out in Ohio.
Let's just say I had to plow my own driveway with my car. Maybe like 24 inches. It's up there. My other cars are all iglooed in.
The region's gotten up to a foot of new snow today, on top of up to 4 feet already on the ground in some places. Texas governor is threatening to pull funding from a children's hospital after a viral TikTok video from a pediatric cardiologist telling patients and parents not to answer a citizenship question. Reporter Chris Fox is in Austin.
Abbott responded with the message, hey, Texas Children's Hospital and Baylor College of Medicine, this doctor is putting your Medicaid and Medicare funding at risk. Pastor doesn't believe Abbott's trying to recoup medical costs.
I worry that this is information that people are going to use to deport people.
The new order on intake forms went into effect November 1st. If predictions prove true, a lot of people will be spending at least some of today doing their holiday shopping online. Adobe Analytics' Vivek Pandya.
We're expecting Cyber Monday to be the largest online shopping day of the year, really of all time. We're expecting about $13.2 billion to be spent on Cyber Monday.
The good book's been selling like hotcakes. CBS's Jim Krasula.
Some might say hallelujah. Sales of Bibles are up 22% over the past year, with many first-time buyers. Publishers attribute the increase to rising anxiety, including over the election, and a search for hope. Print book sales in the U.S. have been up less than 1% over the past year.
The Dow is down 162 points. S&P up 5. This is CBS News. The White House is decked out for the holidays. CBS's Stacey Lynn takes a peek.
The first Christmas tree display featured on the White House tour is dedicated to Gold Star families. The Gold Star trees honor the heroic men and women of our nation's military. This year's Gold Star tree exhibits constructed of 6 oversized and stacked stars representing all 6 branches, and names of fallen service members are written on Gold Star ornaments.
There are a total of 83 holiday trees on display throughout the White House. The Oxford English Dictionary has taken a cue from young people and all that time spent on social media to select its word of the year.
Hi. Are you suffering from brain rot?
Oxford defines it as supposed deterioration of a person's mental or intellectual state, particularly stemming from overconsumption of trivial online content. The company says usage of the term brain rot jumped by 230% over the past year. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Podcast. That's where you'll find us coming up. We're going to get the latest. We got some economic data, PMI data came in. I think the headline was a little bit better than expected, but some mixed numbers. We'll break it down for you. Ben Sills, Bloomberg Managing Editor for European Economy and Government we got some news coming out of France. The far right in France to back a no-confidence motion against the French government. That sounds serious. We'll get the latest reporting there. David Waddell, CEO and Chief Investment Strategist at Waddell & Associates on the markets. Woo Jin Ho covers all the technology stocks for Bloomberg Intelligence. He's going to join us here. Super Micro, getting a new CFO here, but I think maybe the worst is behind it. The stock is trading up here, so we'll get the latest there. But right now, let's go to Lisa Mateo and get a Bloomberg Business Flash, Lisa.
And this Bloomberg Business Flash brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn more. All right, let's get right to the economic data. We'll start with S&P Global, U.S. Manufacturing PMI. Survey was for a reading of 48.8, came in a bit higher at 49.7. We go over to construction spending for October, month over month. The expectation was for a rise of 0.2%, came in at a rise of 0.4%. Then we go to ISM Manufacturing for November. That expectation was 47.5, came in at 48.4. If you go to ISM prices paid for November, the survey was for 55.2, came in at 50.3. Of course, Paul and Alex are going to break that down in more detail in just a bit, but all eyes really on that jobs report that comes out on Friday. Let's get to the market reaction now. Now we go to the NASDAQ of 0.8%, 157 points at 19,377. We have the Dow down 0.4%, 183 points at 44,726. The S&P 500 up 0.1% or 7 points at 6,039. The 2-year yield at 4.21%, up 5 basis points. The yield on the 10-year 4.23%, and that's up 5 basis points. The Bloomberg Dollar Spot Index up about 0.6%. We have the Japanese yen, euro, British pound weaker, and Bitcoin down about 1% at 96,000. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here, Paul Sweeney. This is Bloomberg Intelligence Radio. Happy Monday, everybody. Happy Cyber Monday. Happy Shopping Monday.
Sure.
Yeah, why not? Giving Tuesdays tomorrow. Let's keep in mind for that. Let's get more on the manufacturing data, because for the first time in 8 months, new orders entered expansion territory. Joining us for now is Tim Fiore, chair of the Institute for Supply Management's Manufacturing Business Survey Committee, and he joins us now. Hey, Tim, what drove that expansion?
A couple things, Alex. First off, the new order number finally broke 50. I mean, we've broken 50 before in the last couple of years, but we've broken 50 here for a good reason. It feels like demand is starting to come back now that the uncertainty around the election is behind us. That's a good thing. The other thing that validates that is that our manufacturing inventory number actually rose 5.5 points, which would also indicate that companies are more willing to invest in working capital to get ready for the 2025 business year. So overall, a good report. I think the other point here is our employment, although we're still destaffing, we're not destaffing as strongly. we came in at 48.1. So the three of those together got us close to 49. And I'll tell you, if the supplier delivery number, which surprisingly actually got faster, if it had remained slower, we would have broke 49 and gotten closer to 50. So overall, a good report for November, a little bit surprising, a little bit more positive than I would have thought this early, but very consistent with the fact that we're on a rate reduction cycle. The election is behind us. It's obviously going to be a positive thing for the economy. And off we go into 2025.
Tim, great to have you with us. Tim Fiore, chairman of the Manufacturing Business Survey for the Institute for Supply Management, zipping in here with some economic data for came in a little bit better than expected, so we'll take that. I wonder how much of that has to do with the election and some of the economic optimism that is felt in a lot of parts.
Well, and also, I wonder how that winds up looking as we go into 2025, because will we see stockpiling ahead of any tariffs as well, and will that change the inventory and new orders? That could be interesting to figure out, too.
Yep, very good. Looking at the markets here, a totally mixed outlook here. The S&P up a little bit, Dow off about 0.4%, but the NASDAQ up. So go figure out what's happening there. We can check it out with Abigail Doolittle, Bloomberg News chief markets correspondent joins us here in our studio. Abigail, what are you looking at in the marketplace today?
I'm looking at a number of these stocks being moved in different directions by the departures of key executives. 2 CEOs at big companies have left today, including Intel. Pat Gelsinger stepping down as the turnaround has really stalled. That stock down about 50% on the year. And then, of course, Stellantis' CEO leaving as well. Lots of questions about the inventory for that company. And then Supermicro Computer, the CFO leaving. They've done this internal review, and they have found that there's no misconduct, which is similar to what Woo Jin Ho has told me in the past, that he thought that it was just a small company that became very big too fast, and the spotlight was on them. So that stock up 12%, Stellantis down about 7%, and Intel up about 2%. Another stock that has my eye, because the chips overall are higher, Marvell Technology, it's up 4%. It's expanded an AWS pact for AI in the cloud. So lots of the chip stocks actually recovering today.
Yeah, I was trying to think of a moniker like Merger Monday. No, is it like Executive Departure Monday? But that's lame. I mean, I was trying to think of something catchy that started with an M, and Management Monday. I don't know. I couldn't quite get there. What's interesting also is, what are we seeing with the Russell? Are we seeing anything interesting with the small caps? I keep reading lots of notes about the divergence and how we are getting a broadening and breadth of that rally. I think Bloomberg Intelligence noted that a good amount of stocks were over their 200-day moving average.
So it's interesting. The Russell 2000 remains essentially in a range. At this point, though, and over the last couple of months, it's an upward-leaning range. That said, if the range continues to do what the range has done, it suggests that you're going to see the Russell 2000 back down toward the 200-day sooner rather than later. Now, one reason to think it may not go back down into that range is it's actually broken out of an area of congestion. That's probably what has Bloomberg Intelligence analysts and maybe her name is escaping me right now.
Gina Martin Adams.
Yes, Gina Martin Adams, particularly excited.
Yep.
And of course, from a fundamental standpoint, this is a big part of the Trump trade. These companies tend to be smaller, more domestically based. And so if his administration is indeed protectionist, and we have every reason to believe that could be the case, that should help out those smaller companies.
Abigail, thank you so much for joining us. Abigail Doolittle, chief markets correspondent for Bloomberg News, joining us here in our Bloomberg Interactive Brokers studio. Market Drivers today is brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. Well, the political news today is coming out of France. The far-right National Party of Marine Le Pen will back a motion to topple the French government after Prime Minister Michel Barnier failed to agree to all of its demands on next year's budget. Let's get the latest reporting there with Ben Sills, Bloomberg Managing Editor for European Economy and Government. Ben, can you educate us as to what's happening in Paris right now?
Yeah, well, it's difficult to keep up, to be honest. We've got the headlines breaking on the terminal right now, just in the last few minutes. As you say, the far-right party of Marine Le Pen has come out and announced that they are going to vote to bring down the current administration. It's been a really dramatic few days. The Barnier government has been walking on thin ice ever since it was formed in September. their lack of a majority in the parliament meant that Marine Le Pen effectively had the power of life and death over that government. Barnier has been desperately trying to get his budget through. Feels like every other day for the last week or so he's been caving in to one demand or another. He's now, by my reckoning, given Le Pen 3 or 4 of the main demands that she wanted. She's still not happy, and so she's decided to pull the plug on the government.
Right, and by forcing it through, therefore, thus, a vote of no confidence can be called. Within the market, we are looking at a weaker euro. There's also been a lot of talk about how the difference between yields in Germany and yields in France, well, France and Germany, has blown out, and that it's at the level that we haven't seen since the European sovereign debt crisis back in 2012. Wow. It's an easy comparison to make, but it's very different when you look kind of under the hood at that.
Yeah, absolutely. So, I mean, the threshold that we were struck by last week was when the French bond spread actually went wider than the Greek bond spread. You know, those of us who were around 10 or 15 years ago when the sovereign party, with the sovereign crisis blew up, got used to tracking the Greek spread, but we never really thought that France would be in the same boat.
So where do we go from here? Where did the French go from here, and kind of what's the time frame here?
Yeah, that's a good question. I mean, I think that in terms of the kind of the next steps, we'll be looking for the no confidence vote to happen in the next couple of days. We would expect that to go through. That doesn't really resolve anything, though, because under the French constitutional rules, they can't hold another election until next July, I think. And so there's no way to put this to the vote to get a new kind of parliament there. So Macron is going to have the same complicated, divided legislature to work with. The parties are going to have to try and come up with a new agreement for governing. But I think everyone's going to be looking at Le Pen. She's setting the agenda here. She's the one who has decided to force the issue, and so there will be a certain onus on her to make the first move when we come out the other side of this crisis.
And one of the triggers for this was, of course, the snap election that sort of set up the government like this in the first place. Are we at risk of having that happen again?
Yeah, I think that, you know, this is something that's been building for a long, long time in France. Le Pen has been a fixture on the political scene there for, you know, more than a decade. She had her first presidential run against Macron in 2017. And so the French establishment has been coming up with a series of kind of increasingly creative ways to keep her out. But her stock is higher than it's ever been before at the moment, and you can see that by the way she's leveraging her power this week. The end game really centers on the 2027 presidential election. That's when Le Pen is really aiming to finally take power in France. The question is, does Macron hold out till then? There has been speculation in France that he might quit, but you know, he's insisted he's not going to do that. So that means we're kind of in this sort of slight limbo situation where no one can really govern, but they can't force an election.
Ben, thank you so much for that reporting. Appreciate it. Ben Sills, managing editor of Bloomberg News. He is coming in from our Berlin, Germany studio on the latest news coming out of France. Some political instability right there. We're seeing that in the euro, which is off more than 1% here. 1.047 on the euro to the dollar. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
This Bloomberg Business Flash brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit IBKR.com/forecast and get started today. Well, we've got stocks mix, and this is after more economic data. That included U.S. manufacturing activity shrinking in November by less than forecast as orders expanded. So we have the NASDAQ up 0.8%, 164 points. The Dow down 0.4%, 194 points. The S&P 500 up 0.1% or 6 points. The two-year yield 4.21%, up 5 basis points. The yield on the 10-year 4.23%, and that's up 5 basis points. To currencies, we have to point out the euro. It is weakening right now. The euro down nearly 1%. This is after political turmoil in France. The far-right party of Marine Le Pen backing a motion to topple the French government. The party is actually looking to dissolve the current government. We have the Bloomberg Dollar Spot Index. That is up about 0.6%. A few companies making news. That's Intel. Its shares up about 2%. It announced that its CEO, Pat Gelsinger, retired from the company, stepped down from its board. Stellantis also seeing a leadership change, too, with CEO Carlos Tavares. He stepped down earlier than expected after a dispute with its board. ADR is down about 7.5%. And Super Microcomputer, they say they will replace its CFO. It also revealed the special committee has found no evidence of misconduct on the part of management board. Shares are up about 15%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance and politics from our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. We also tap wonderful guests outside of Bloomberg Intelligence for their broader take on the market, particularly after a really stellar year. Here's some facts for you. S&P is up almost 27% on the year, the best performance through November since 1997. And going back 50 years, the S&P has always gained in December after rising 25% or more in the first 11 months. That's a technical way of saying the rally could continue. Well, joining us more for his take is David Waddell, CEO and Chief Investment Strategist at Waddell & Associates. He joins us now in the studio. David, good to see you. Thanks for joining.
Good morning. Nice to be here.
Is that the deal? Like, hey, we're up. Just to keep buying it. Why not?
I think the number of occurrences in that sample space was rather small, but we'll go with it.
Okay.
So I think the Santa Claus rally can continue. And, you know, what's amazing is that earnings are accelerating from here, right? So as we look out over the next 24 months, earnings grow 15% next year, maybe 15% the following year. And so with that as a backdrop, and by the way, here's a nice stat. In years where there's not a recession, markets are higher 86% of the time. So it bodes well for next year, and I think people are squaring that going into the end of this year.
We're almost a month past the election. When you woke up the day after the election, did you and your team, did you rethink maybe your outlook for asset allocation or maybe how you think about investing? Did the change in administration and the Republican-controlled Congress, did that change how you looked at things?
It's a great question. So to a certain extent, we were also already anticipating a move down the cap spectrum. You know, I don't think the MAG 7 go to the LAG 7, but other people should participate, and they have in the second half of the year. So we'd already sort of moved down the cap spectrum, which is part of the Trump trade. The part I hadn't really anticipated was how strong the currency reaction was going to be. So our offshore holdings currently are unhedged. That's up for discussion now in terms of, because the move in the currency has been dramatic. And that may be the big story for next year, less so interest rates, since it appears that the markets like our new Treasury nominee. But that's up for discussion on the investment committee, is whether to hedge currency or not.
Well, that's actually quite interesting because President-elect Donald Trump has made no bones about the fact that he wants a weaker dollar. But then the threat over the weekend to the BRICS nations about you still have to use the dollar, and we know that tariffs are coming. How does that square itself?
I don't know, and I keep going through that gymnastics in my head, but I'll tell you the most interesting thing to me is U.S. imports are $4 trillion. If Trump slaps 10% tariff on that, you know, it's $400 billion in potential tax revenue. Now, my economics textbook says, well, that just means that Ford producers are just going to raise their prices 10%. Well, the dollar's appreciated 8% since the end of September, which almost negates that in the marketplace. So I think the interplay between the tariffs and the movement in the currency may be the most interesting thing going into next year. And again, that may just be, statecraft and jawboning and not really policy, but more negotiating positions. We won't know. But I think the currency is the most interesting.
U.S. versus non-U.S., how do you guys position that, generally speaking?
Well, so we benchmark against the all world, the ACWI, and we've been tilted towards the U.S., but the valuations overseas are much more compelling. The earnings growth is okay, but Europe seems anemic and continues to struggle. I think, the stock market in Germany, and if you look at earnings in Germany and the size of that economy, hadn't done anything in the past few years. And so it makes it somewhat challenging to defend that position. But right now, at the moment, with policy being so uncertain, I don't think it's time to be making large transitions either onshore or offshore. But obviously the bias is towards the U.S. right now, and that's reflected in the currency markets.
So what do you think it's going to take for you guys to make a decision whether to hedge your ex-U.S. exposure? Like, what's going to tip the scales for you guys?
I would never fully hedge it, probably, because, again, currency markets are fickle and challenging, and things can change a lot with policy proclamations. Right now, we're fully unhedged. In terms of what portion of that to hedge, I don't know. That'd be a position-by-position decision.
Okay.
It seems like ever since I've been in this marketplace, June 16th, 1986, by the way, growth has been the story.
Yeah.
How about if you're a value investor? What do you do here? How does this new world that we're kind of entering, how does that?
I've been making the standard deviation argument for a while, which is that performance and valuations have reached extreme levels. That is true. But if you look at this year, utilities have outperformed technology, right? Financials have outperformed, industrials have outperformed. And if you look at the trade since Trump, value's done very well. I mean, the Mag 7's done fine, but mid caps, for instance, which are more value laden, have outperformed small caps, which obviously have a lot more financials, since June 30th are up twice as much. So I think, I hate to say, we're overdue because we've been overdue for a while, but I do think the value trade has some substance to it. And if what we're trying to do is drill another 3 million barrels of oil per day, which is a ton because we're drilling, 13 and change, that's going to benefit materials companies, that's going to benefit industrials companies, and a lot of the Inflation Reduction Act infrastructure spending hasn't even come out yet. So I think industrials end up being kind of the darling. In Trump 1.0, energy actually was negative, even though the S&P 500 was up 70% over that period of time. So, I'm not sure all value sectors benefit, but I would say industrials look good. Financials can continue to look good, especially with less regulatory pressures, and materials should look good. So, and utilities, the earnings there are pretty substantial, and there's some obvious link with what's going on in AI. So it may be that value's overdue and that 2025 will be the year of value. We'll see.
We'll see, exactly. I was going to say, who doesn't like 3 million barrels of oil a day, extra oil? Oil companies.
That's right, which is why the industrials and the materials seem more attractive.
What do you do then with tech? You said, earnings outlook for technology is definitely going to be lower next year, right? But it's not nothing.
Right.
It's still going to be double digits, probably in the mid-teens. How do you invest in big tech currently?
Well, it's kind of curious, if you look at the stocks, like half
the semi-index.
Yeah, half the stocks in there are negative this year, and I think the index itself is up about 13%. So it had a great 2023. It did not really have a great 2024. But if corporate taxes are $450 billion, and Trump's going to cut them by another 33%, that's going to create a lot of ammunition for CapEx. So I don't think the tech trade is over. It's just more fun when other people participate as well. So I think everything.
So you don't have to sell tech.
No, I don't think you sell tech. But I do think you start moving towards more mid-cap, small-cap exposures. In fact, since Trump, I think, was elected, the #1 performing factor was small-cap growth. So mid-cap tech, small-cap tech, a lot of CapEx. I see all of that as bullish.
Bond market, 2-year Treasury 4.2%. Or do I take some credit risk here?
Here's the thing. So during Trump 1.0, nominal GDP was 4.8%. Real GDP grew 2.8%. Inflation was 2.1. So we're sitting on the 10-year, which is where the equity market really prices, at 4.22 or something, call it, whatever it says. That means that we're priced appropriately from a PE perspective for the stock market. So I think things have got it right. What'll be curious is when the Fed comes out on the 18th, they'll release their summary of economic projections, and we'll see where they think the neutral is. Obviously the number of rate cuts has come off the table to about 2.5 over the next 12 months. And so there's a lot more tensile strength in the economy than people thought, and we'll get, I guess, the ISMs this morning. I'm looking forward to that.
Yeah, they were actually pretty good.
Yeah, did manufacturing go positive?
So the new orders went into expansion territory for the first time in 8 months. The other parts of the indices didn't, but it was close.
Yeah.
And we heard the inventory started to rise again, so really gearing up for a business cycle in 2025.
Yeah, and where was service? I guess we'll get services tomorrow.
Later, yeah.
So if manufacturing turns the corner and starts being expansive, then where should the neutral rate be? So I think that's the big question mark. But I think we're back to 2.5 rate cuts. Although, I'd love a Christmas cut on the 18th.
Right. Do you think we're going to get that? Or
They broadcast it. I don't know where the CME tool is. It was at 66% when I looked over the weekend.
It looks like we are priced in for at least one. But
good.
Yeah.
That'd be great.
Okay, you like that. And ISM Services is coming up on Wednesday, so we'll break that down to you as well.
David, you're based in Memphis, Tennessee, right?
Memphis and Nashville, yeah.
Memphis. Talk to us about Memphis. I haven't been to Memphis. I don't think I've been to Memphis. Talk to us about the economy down there. What drives Memphis?
Well, right now, Elon Musk, because he just decided to build his AI data center in Memphis, Tennessee.
Oh,
yes,
excellent.
Exactly, and doubled the capacity immediately. And, they continue to raise money for XAI, which means more capital expenditures. So there's a lot of industrial expansion going on right now because we have a great power grid. We've got a great logistics network. Our anchor tenant is FedEx, which is the global nervous system from a trade perspective. And so I would say Memphis is a value stock, right? With an opportunity to buy it. You run 3 hours up the road. Nashville is a growth stock, and headquarters just continue to move there almost every single day. So it's an age of renaissance in the state of Tennessee right now.
I tell you, you read about it. I'm just looking around here. Memphis, Nashville, you hear so much about Tennessee. It seems like every car company. What's it about Tennessee?
Well, Corker was good at that too. Yeah. So we had great political leadership. Bredesen was amazing. Corker was amazing, and Nashville has been very aligned on a growth agenda politically, philanthropically. In the private sector, obviously, and so it's just, it's a great time to be in Tennessee.
And Nashville's become which I don't know why, the bachelorette party capital of the world, surpassing Vegas.
The only time I was in Nashville was with you with radio, but I was so sick I didn't leave the hotel the whole time for 3 days. So
it's good times. Come back.
So that hotel was nice.
It's a great time.
They had nice Starbucks. All right, we appreciate your time. Thank you so much, David. David Waddell, CEO and Chief Investment Strategist at Waddell and Associates. All right, coming up, we're going to talk about all the management shuffles that we've seen so far this morning. Next up, we're going to talk about Super Micro and the positive news there. That stock getting a nice big jump. Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst, will be joining us on the first day of December of trading in the market. S&P up 0.2%.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, we've got a mix of red and green on the screen. We're kicking off the first trading session of December. The NASDAQ leading the gains up 0.9%, 178 points. We have the S&P 500 up 0.2%, 12 points. The Dow down 0.2%, or 104 points. The two-year yield, 4.21%. That's up 6 basis points. The yield on the 10-year, 4.22%, and that's up 5 basis points. To commodities, Brent crude, $72 a barrel. We have WTI crude, $68 a barrel. Spot gold at $2,645 an ounce. To currencies, the euro on course for its worst day on a closing basis since November 6th. This is after political turmoil in France. It's now down nearly 1% at 104.72 against the dollar. The Bloomberg Dollar Spot Index up about 0.7%. Bitcoin right now down nearly 1% at around 96,000. We have shares of Gap up 5%. It was upgraded to overweight from neutral at JP Morgan. That was following a meeting with the company's CEO and CFO. And then you have shares of Tesla. They're up about 3%, and this is after an upgrade from Roth. Also, Stiefel boosting its price target. And finally, Volkswagen, that's making some news. Its workers across Germany began temporary walkouts after failed cost-cutting agreement talks with its management. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news, business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. All right, let's get to one of them right now, Supermicro Devices. Supermicro, I should say, up solidly. At some point, it was up like 30% today, up 22% now at this point. The Supermicro reviews finds no evidence of fraud, and the CFO was replaced. Let's get more on this. Woo Jin Ho, a Bloomberg Intelligence senior technology analyst, joins us now. Remind us what the problem is that Supermicro is trying to correct.
Yeah. Hey, Alex. Thanks for having me on. A couple of things. There was a short seller report back in August citing that there was some fraud, with internally, and essentially because of that, there was an internal investigation, and they delayed their 10K and 10Q filings. And what Supermicro is essentially saying, their internal investigation has found nothing or no evidence of fraud. But the 10K and 10Q filings still have yet to be filed.
But it's not every day that a Big Four accounting firm does what happened here. Basically says, they really can't rely upon the management team, and they just walk away from an account. That doesn't happen very often.
No, Paul. I think between your lifetime and my lifetime in the financial industry, probably 4, 5 times, right? So yeah, it doesn't happen. It doesn't happen. They did find an alternative, BDO USA, and quite frankly, with the special investigation, being completed without evidence of fraud, it actually almost gives them BDO a safety net to actually expedite the 10Q and 10K filing sign off, in my opinion.
So does this put all the questions to bed at this point?
No, not necessarily, quite frankly. I mean, let's see what BDO says. I do think they're going to try to push along the filings as quickly as possible, possibly by year end. The deadline is sometime in late February, but, I do think they'll try to push it along. Now, I will tell you, the other question is that was there so much reputation damaged because of this? Did they lose business? And if you think about where the shares are today, it's still well off the peaks.
Mm-hmm. So, assuming they can put this issue behind them, what is the story for this company here, Supermicro News? How do you position it within your tech stocks?
Yeah, look, Supermicro has been one of the hottest companies within the hardware industry. They were on the forefront or the poster child of AI servers. And you've seen a rapid rise in sales going from $1 billion or $3 billion in annual sales, and they were on track to about $26 to $30 billion in annual sales in fiscal 2025, right? And this is over a span of 4 years. Now, they didn't retract guidance, but they didn't affirm guidance either. So the question is that, look, what is the real sales going into fiscal 25? We do have a scenario analysis that in a draconian way, it's going to be $16 billion in sales, right? That's far off of the 26 on the low end, but it's still $16 billion in sales that Supermicro could deliver on the AI story alone.
And this is AI hardware, right, versus AI chips, for example, from NVIDIA, right? So a competitor would be like Dell, right? Like an AI
Dell.
server play.
Exactly.
So if I was a customer and I was like, you know what, Supermicro, I need to go somewhere else, is the only other option Dell, or are there other players out there?
Oh yeah, look, if we go back to last May at NVIDIA's conference, there were a host of AI server companies that were willing to partner with Dell. With NVIDIA. So Supermicro is not the only game in town. Neither is Dell nor HPE. There are some Taiwanese ODMs that are more than happy to assemble AI servers out there. So we've seen because of the growing competitive pressure, we've seen margins compress as a result for the industry.
So they sacrifice, it feels like, the CFO here. How does the street feel about the rest of the management team, the leadership, as well as the board?
Well, look, the main issue in my mind was not only the CFO, but also the board. When you have the wife of the CEO as a member of the board and a 17-year-old person on the board who's been on for about 17 years, there's a very limited independence. Quite frankly, I do think there needs to be some sort of overhaul of the board. And I've said in the past on this show, and I have written that I think the CEO may need to be promoted to a chairman role and may need a new CEO.
Now, what part of all of this has to do with just going from a company in the Russell to the company in the S&P and just growing super fast and having different kind of analyst coverage? And how much of this was going to come kind of no matter what?
Yeah, that's a good question, Alex. Look, this used to be a Russell company or a mid-cap company, and it was under the radar for a lot of analysts. And now we're talking about being in the S&P 500 index, and you're going to have a lot of magnifying glasses on the financials. And keep in mind, it's only been about 5 to 6 years back where they were delisted from the NASDAQ, and for them to do this again, it's quite frankly shameful in my mind. Now, if there is no wrongdoing here, shame on me, right? But fool me once, shame on them. Fool me twice, shame on me. So, you're going to see a lot of scrutiny going forward. I don't know if they'll come back after this.
Have they lost customers to any material basis?
Nothing reported as of yet. What they said on the last earnings call was that there were a couple of customers who they're trying to retain.
That's a nice way of saying not yet. I think from a CEO speak. How much more? Okay, so just pure valuation perspective. How do we know how to value this company when there are all these questions?
Look, at the end of the day, and Paul taught me well. It's all about cash flow and earnings.
Nice job.
And I don't know what earnings is. In our scenario model, we have $1.60 in earnings going forward. And hardware companies of this ilk, AI companies, are ranging anywhere between 10 to 15 times. So if my $1.60 is right and it's going at around, let's just say at the high end, 15 to 16 times, it seems like from a valuation standpoint, it's trading at the fundamentals.
All right, Woo-Jin, thank you so much. We appreciate it. Woo-Jin Ho, Senior Technology Analyst for Bloomberg Intelligence, down there in Princeton, New Jersey. Supermicro. Looks like they're trying to make some headway here. They let go their CFO, but it looks like they're going to get their accountants to sign off on some of their financial statements that'll allow them to file their Ks and Qs and maybe get some of this accounting issues behind them. Because as Woo-Jin was saying, before this accounting issue, there was a high-flying stock and really believed to be and discounted by the market as one of the plays for AI right here. S&P 500 up 11 points. Dow's down 110. NASDAQ up 170 points. That's 0.9%. So a little bit of differentiation out there in the marketplace here today. WTI crude oil pretty steady here, just above $68 per ounce. Bitcoin It coming back a little bit, just below $97,000 per token, off about 880 points. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from the Interactive Broker Studio in a really cold Midtown Manhattan. This wind chill thing, it's like 20 degrees lower than how it actually is. It's not pleasant. Yeah, here we are. Welcome winter. Okay, so let's get to the Bloomberg Big Take story. We love looking at it every day. It really gives an in-depth research and deep dive into some of the most pressing topics of our time. And for the latest, we go to Brendan Murray, Bloomberg Global Trade Editor. And today's Big Take is a roadmap through the drama and realities of Trump's trade war. It also was in conjunction with Bloomberg Economics that had some really good numbers out about the impact of a trade war on everything from kind of jobs to imports to inflation, etc. So, Brendan, when you guys did this, the drama and realities, you're trying to separate out what, the rhetoric from the numbers?
Yeah, exactly. So if you add up all of the tariff threats that incoming President Trump made over the past week, about half the world's population of 8 billion people would be hit if you take the countries that he targeted. So there's a lot to unpack here. And so what we tried to do was separate the rhetoric, the late night social media posts from the more procedural approach that the Trump administration is going to have to take take when it comes to rolling out tariffs. We talked to people who were in the previous Trump administration and supervised the last tariff design, the design of the tariff package, and we got a sense for how this next wave would be rolled out. So what we came up with, Bloomberg Economics crunched these numbers, and you're looking at 3 waves of tariffs starting in the summer of 2025, and by the end of it, at the end of 2026, the average tariff rate in the U.S. is going to go up by about triple. So from 3.5% to about 7 or 8%. So, and China is going to bear the brunt of that.
Do tariffs generate revenue for the U.S. government?
Yeah, they sure do. The customs revenue, the Treasury reports those once a month, and they would generate revenue for the U.S. government. Whether they'll generate enough to close the gap that tax cuts, extending tax cut, will create is a whole other question. You have to go back 100, 150 years to see when tariffs were actually a sizable part of the U.S. budget. At the moment, they're a tiny fraction of overall U.S. government revenue.
What I also find interesting in the piece, you guys talked about how the tariffs will mostly be on intermediate and capital goods. So how does that, first of all, what does that mean specifically? And then what does that mean for, say, a small business versus me?
Yeah, so those are good. Those are not final consumer goods. Those are parts and machinery that go into the making of consumer goods. So the thinking there would be, number one, is that you could source those from another country other than China if the U.S. put tariffs on these capital and intermediate goods. So that would be the first consideration: is could you replace what you already get from China from somewhere else? And then the goal there would be to soften the inflationary impact that we pay at the store, at Target or Walmart or wherever we're shopping for consumer goods. That the goal would be to soften the inflationary impact. But there comes a time when you can only put tariffs on so many goods, and then you start to hit those products that we pay for as consumers.
What do most economists think the retaliation will be on the part of these governments? Because that's also a level of concern. How do we expect some of these foreign governments to respond?
Well, if you listen to President-elect Trump, he would say that, look, I threaten these tariffs against countries, and they come to the negotiating table and they give us what we want, fairness in trade, or in the case of Canada and Mexico over the past week, more border security to prevent the flow of fentanyl and illegal migration. So it's more than just it's something other than just a way to collect revenue or to fix trade imbalances. It's to President Trump a way to exert foreign policy priorities as well.
Right, which it looks like we maybe lost your audio. Can you still hear me, Brandon?
Yeah, I can hear you.
Okay, I gotcha. Which makes it even more difficult to game out, right? Because you don't know how much of that is going to be just a strong arm to get other things, and how much of it is actually going to be implemented, and then what the retaliatory factor are. What's the level of conviction when you were speaking to, say, Anna Wong of Bloomberg Economics and other peers in the area? What's everyone's conviction on their calls right now?
Well, no one can make a call right now with any high level of confidence. There, as we lay out in this big take story today, there are just a lot of unknowns. How the degree to which the president-elect is threatening, rather as opposed to things that he'll follow through on. So this is what we call a plausible scenario. It's one that's based on the modeling that Bloomberg Economics does, the reporting that our Bloomberg News reporters have done, speaking to people who were there for the first time, and gaming out how it might happen the second time. So it's an attempt to describe the method that will come with a lot of the perceived madness of trade wars in the second Trump administration.
All right, Brendan, thanks a lot. Really appreciate it. Thank you so much for joining us. Brendan Murray, global trade editor over at Bloomberg News, joining us in the Bloomberg Big Take story. And you can read more of this story on the Bloomberg and at Bloomberg.com/Big Take. All right, coming up in the next hour, we're going to talk more about the Management Mayhem Monday. Hey, I did it.
There you go.
Mayhem Management Monday. Something I'm going to work it out over the break. But Steve Mann, a Bloomberg Intelligence Global Autos Industrials Analyst, will be joining us on Stellantis. And Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, will be joining us on Intel. So we'll get the scoop on both management stocks there. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great second hour lined up for you. We're going to tackle all the management changes over at Intel as well as Stellantis. Both Steve Mann and Mandeep Singh of Bloomberg Intelligence will be joining us on that. Plus, Peter Anderson, Chief Investment Officer and founder at Anderson Capital Management, will be joining us for his broader take on this market after we're up almost 27% year to date for the S&P. And Mackenzie Hawkins from Bloomberg News Technology Reporter will dig deeper into the U.S. tightening curbs on China's access to AI memory and chip tools. So lots to discuss. Looking forward to this next hour. But let's get you caught up right now with a Biz Flash. Here is Amy Morris. Amy?
Thank you, Alex. Supermicro Computer shares now 20% higher after it said an external review of its business by a special committee of its board and external counsel found no evidence of wrongdoing and that the company will appoint new top financial leadership. The company says it's looking for a new chief financial officer, chief compliance officer, and general counsel. The euro is weakening after political turmoil in France. The far-right party of Marine Le Pen is backing a motion to topple the French government. The party is looking to dissolve the current government that has the euro trading now at 1.046 against the dollar. U.S. manufacturing activity shrank in November, but by less than forecast. ISM data beat estimates, rising to 48.4. And we check markets for you all day long here at Bloomberg. The S&P 500 little changed on the upside. NASDAQ up 0.8%. The Dow is down 0.4%. The 10-year Treasury yield at 4.21% and the 2-year yield at 4.2%. Intel shares now 3.7% higher. Intel says CEO Pat Gelsinger retired and stepped down from the board effective yesterday, December 1st. Intel's board has launched a search for a new CEO. CFO David Zinsser and Michelle Johnson-Holthaus serve as interim co-CEOs. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris, and that is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Amy Morris. And as Amy was speaking, we get the headline that Bloomberg is now reporting that Intel CEO Pat Gelsinger was forced out after the board grew frustrated with the progress of the company.
Yep, that seems clear to me.
Yeah, I mean, we can track though. We can look along the dotted lines there. That stock still up almost 4%. All right, let's get deeper into the market here with some market drivers, and for that we go to Abigail Doolittle, Bloomberg News equities reporter. All right, Abigail, what are you watching?
Well, it's certainly Intel here, up 3.6%. Never a good day for the CEO who is getting booted or the management team when the stock responds positively. It's off the highs it had actually in when this news first came out, been up closer more than 5%, but nonetheless up 3.7%. And on this idea that maybe if they bring in new leadership, the turnaround, the long-awaited turnaround for Intel will happen in terms of more manufacturing in the U.S. and the fab. So that's certainly one stock on the move. Supermicro Computer, speaking of being on the move, it is now up 21%. This on the news out of that company that an independent review found no signs of misconduct, but they did make the recommendation that top financial and legal folks should leave. So they are having their CFO leave. The stock, since essentially saying that BDO was their new auditor and that they're making arrangements or attempting to make arrangements with NASDAQ to keep that listing, now up more than 120%. 1%. So a big relief rally for that stock that's been all over the map, that massive rally and then the big decline, all of it having to do with AI. Speaking of AI, we also have Marvell, one of the top stocks for the chips index, which the stock's right now up a very healthy 2%. Interestingly, it's deeply in correction territory from its last high, but up today, up 2%, and Marvell is rallying on an expanded AWS pack for AI in the cloud.
Anything? We're pretty much all done earnings, right? Do we have anything coming up? I mean,
I feel like
Dollar
there's
Generals.
always,
Yeah, I feel like we got some of the dollar stores and things like that.
Well, they've had a rough road this year.
Yeah,
I mean,
they
that's
have.
interesting in terms of the bifurcation that we continue to see for the consumer and Dollar Tree and Dollar General in this time of maybe inflation isn't the way that it was a couple of years ago, but still things seem pretty expensive, at least to me.
Dollar Tree is the fourth.
The fourth. So
yeah, in market.
And these companies have really done poorly. They're saying that they're actually losing some of their lower income consumers, which that is certainly a sad situation. And then we also hear about the higher income consumers going to the likes of Walmart, really primarily Walmart, for bigger deals. I'm also just taking a quick look here, and it looks like we have Five Below reporting. We also have American Eagle. So, and speaking of Super Microcomputer on the 5th. So yeah, it feels like there's always earnings season. It's so spaced out at this point.
You know what? Torsten Slok over the weekend was out with a great note, just talking about inflation and kind of where those levels are. So he had some good numbers. The CPI index is 22% higher than in January 2020. So the growth rate has come down, but it's still higher. This means that the prices of all goods and services that consumers spend money on are up on average 22%. For example, since January 2020, the price of cereal, 30% higher. Household electricity, 32% higher. Car insurance, 52% higher. So while the growth rate that you and we all talk about, it doesn't go to the fact that, boy, the prices that we're all paying are so much higher than where they were
I certainly feel that in my own life.
So I was just seeing that good data that Torsten always seems to get his handle on. Abigail Doolittle, thank you so much. We appreciate that. Abigail Doolittle, market correspondent here for Bloomberg News. News coming out of the auto business. It seems like there's just more turmoil, turnover there. This time with Stellantis, CEO's early departure there. I don't know what that means. Stellantis, it's the old former Chrysler, and then with some other European companies. I forget exactly what they are, but Steve Mann will help us out here. Steve Mann, Bloomberg Intelligence, Global Autos Analyst. Steve, talk to us about what's going on with the folks at Stellantis.
Personally, I think it's probably a pretty bad timing for the CEO to make an exit at the moment. They are facing really tough market conditions. In Europe, in the U.S., and, to a certain extent, some emerging markets. So, Carlo's been, he's been very good at controlling costs, and that's what we need at the moment to adjust to the current market condition. So I think as you can see, the stock's down 7-8% right now. The market's not reacting very positively on his early exit.
So what's your read then on why now?
Well, I think, Carlos and the management team has done a lot. He's made some management changes to really bring down the inventory in the U.S. That's where the pain is. They typically get, adjusted operating income of double digits in the teens, but that's been down to single digit in the last quarter. So there's a lot of work to be done to actually bring down inventory in the U.S. so they can actually try to get some, pricing on their new models that's coming out at the moment. So a lot of work to be done, but it's his leave. Look, it's really out of his control at the moment. He's done all he can, Carlos. That is, it's really it's something he couldn't control. It's the market. Every automaker is facing a similar situation around the world.
And I think what we're seeing, I guess what I'm piecing together from reading your research and reading the Bloomberg News reporting here is kind of as it relates to the global auto industry, Europe's in a tough place because, again, like everybody else, they're not sure about this transition to EVs. Yet at the same time, China is flooding the market with electric vehicles, so it makes it even tougher for the incumbent manufacturers. Where are we in that process?
Yeah, it's an interesting industry right now to follow because there's all these dynamics. There's new competitor. It's becoming the 800-pound gorilla. China, which, you know, it's coming into the market not just in Europe. They're thinking about coming into North America. We'll see how that goes with Trump in the office. But you know, EV is tough. You know, a lot of countries in Europe have cut back subsidies for consumers. So, you know, you hear Volkswagen closing plants, 2-3 plants in Europe. So it's going to take time to work out. I think we're going to see pain through 2025.
Where is the biggest pain point? Because you just listed off a lot of stuff. And when I think about car makers, I think, ooh, EVs, right? Like, it's not yet really profitable for these guys to make them, but you got to make them in order to make the prices lower and make them competitive and kind of put it out there and get the supply. Is that really the issue, in addition to Chinese competition, or a traditional auto landscape also struggling? When it comes to Stellantis, I should say.
That's a very good question. It's really not about EVs. You know, EV only makes up less than 10% of a lot of these companies' annual sales. So it's not really EV. It's really the ICE vehicles that, you know, during COVID, we had a lot of shortages because of the supply chain constraints. But over the past couple years, with that supply chain constraint going away, they've been producing a lot of vehicles, and they're refilling that inventory. And with higher interest rate over the last, past few quarters, you see that inventory piling up, and now they can't sell the cars, but at the same time they're going to have to drop prices, and the worry is it's going to spiral out of control, not only for Stellantis or Nissan, but for the rest of the auto industry. You know, price cutting is not where the industry needs to go right now.
So talk to us about Stellantis, their brands in North America. How are they faring now?
Yeah, that's also a very good question. I think Carlos really had, the former CEO of Stellantis, really had a tough job. Not only does he need to manage the new market conditions that he's seeing in a lot of developed markets, but look, Stellantis is really an amalgamation of brands that a lot of automakers didn't want, right? You know, I think, you know, in the North American market, you know, I think GM and Ford are probably more of the go-to brands. You know, third is the Asians, and then, you know, Stellantis is, you know, Jeep and Dodge and Chrysler. They're kind of they're famous brands, but it's not at the top of the consumer's wish list. You can say the same thing over in Europe as well with Fiat.
Right, because I guess from what I hear, and this is, let's be clear, just a Matt Miller thing, you like trucks, right? Like, yes. Trucks is the thing. Like, pickup trucks is the thing.
Ram trucks.
Right. Those stuff. Does Stellantis, what's their market share in that arena?
Well, they still have, you know, they're top three. They're third, behind Ford and GM, Chevrolet. You know, when they came out with the new redesigned Ram truck a few years ago, they did reach the #1 market position in the U.S., but it has since then has fallen off. And, you know, their vehicles are getting old. Their pickup trucks needs a new redesign. Their SUVs are going through that process right now. They need to come out with new products to really excite the consumers.
Steve Mann, thank you so much. We appreciate it. Steve Mann, Global Autos Analyst for Bloomberg Intelligence. Other news today on the tech side, turnover, particularly at Intel. CEO would now... Oh, sorry.
You got it. You're right there. You want some water? Set. He's all set. Okay.
Bloomberg News is now reporting that the board has forced out Intel CEO Gelsinger. So definitely some concerns there at Intel as it tries to play catch-up on the AI game against the NVIDIAs of the world. Mandeep Singh joins us, Senior Technology Industry Analyst for Bloomberg Intelligence, joins us here in our Bloomberg Interactive Broker studio. So again, Mandeep, the reporting we're seeing out of Bloomberg News now is that it was kind of the board forcing out Mr. Gelsinger, and that kind of makes sense because, you know, as you mentioned earlier, board concern, investor concern about the pace of which Intel was trying to, you know, really become a bigger player in AI. What do you think's going on there in Intel?
Yeah, and the overall strategy for a turnaround like this. I mean, we know turnarounds are rare in tech. And in this case, I think the doubling down on the foundry side was a big mistake in hindsight. I would be very surprised if whoever they appoint, whether it's internal or external, really wants to focus on the foundry side as opposed to their core chip business, which is where they still generate bulk of their operating free cash flow. And when you look at the PC business, it's a $30 billion business, generates $10 billion in free cash flow, and it's still there. I mean, they're not gaining any share, but they're still the dominant force when it comes to the client PC desktop business. And I think that's the path to turn around this company.
Were you surprised by this, in that this happened before there was a successor actually announced, considering that meaning that, like, what's going to happen in the next, say, 2 months while they were looking for a successor that would have meant that Pat Gelsinger had to leave?
I mean, this reminds me a little bit about Microsoft, the way Steve Ballmer left and the way Satya Nadella was appointed. I wouldn't be surprised if one of the co-CEOs, Michelle Johnson, like, she ends up being elevated to the CEO role. But when I look at the turnaround prospects, I think this is a much harder turnaround than a Microsoft, simply because you've got a player in NVIDIA that's really taking share on the server side, and then TSMC on the foundry side. So on both the fronts, Intel is really losing share. The only front where they still have steady share is the client PC business, and that's why I think breaking up the company is probably the likely scenario here. I would be surprised if anyone tries to turn this around as is.
So, I mean, is this an attractive job for an external person? Let's say I'm a senior person at NVIDIA. I can get the big chair at Intel. Is that attractive?
It could be, but it sounds more like a PE playbook here, Look at the entity as a whole, figure out the strategic options, lever up. And look, the foundry business outside of Intel may actually end up doing well. And the reason I say that is right now, no one from an Amazon or a Microsoft or Google or NVIDIA wants to use Intel Foundry because they know Intel is a competitor on the chip design side. But once you take out the company and, it's an independent entity, everyone wants to have some onshore manufacturing of chips. That's what the government wants. So these companies may be forced, and with the incoming administration, I wouldn't be surprised if they say, okay, you guys have to use some of the foundry options within the US. TSMC or Samsung don't have that kind of capacity that Intel has within the US.
So would the pitch be to spin off the foundry business kind of thing and then keep the PC chips and the AI chips?
Yeah, I mean, look, the foundry business is an $18 billion revenue business, although most of it is Intel outsourcing their business and counting as revenue. So it's not external foundry revenue, but it's negative gross margins. So the core PC business is about a 40 to 45% gross margin. The foundry business is negative gross margin. And they're spending $25 billion a year on CapEx just to buy the machines to keep up with the advancement in nodes.
Why do I have a business that has a negative gross margins?
Because it's like Intel is the vertical integrated player in chip design and manufacturing.
Okay, so it's all
so
part
they
of the
do
whole.
it all in-house. And for a while, that's why Intel's gross margins were the best, because they were doing everything in-house. But the moment they missed out on that node advancement where TSMC leapfrogged against them, that's when it all started to go wrong.
Amazing stuff. All right, Mandeep, thanks a lot. Really appreciate it. We'll clearly be talking to you every day on this for a while. Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst, joining us on Intel, and reportedly Pat Gelsinger being asked to leave by the board. All right, much more coming up. We're going to talk to Mackenzie Hawkins, Bloomberg News technology reporter, on tightening curbs on the U.S. and China technology. This is Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. Stocks are heading into the final trading month of the year in record territory. Intel Chief Executive Officer Pat Gelsinger was forced out after the board lost confidence in his plans to turn around the iconic chipmaker, adding to turmoil at one of the pioneers of the tech industry. Shares of Intel now 5% higher. Cyber Weekend e-commerce sales grew 9% in the U.S. this year. That's up from 6% in 2023. Salesforce data showed the average discount was 28%, which is actually down from 2% last year. Salesforce says the discounts have not quite met expectations this year. The euro now down about 1% after the far-right party of Marine Le Pen backed a motion to topple the French government. The party is looking to dissolve the current government. That has the euro trading at 104.7 against the dollar. Supermicro Computer said an external review of its business by a special committee of its board and external counsel found no evidence of wrongdoing and that they will appoint new top financial leadership. Supermicro Computer shares now 22% higher. And we do check markets for you all day long at Bloomberg. The S&P 500 up a tenth of a percent. NASDAQ up 0.8%, and the Dow is down 0.3%. The 10-year Treasury yield at 4.18%, and the 2-year yield at 4.19%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris, and that's a Bloomberg Business Flash. Paul and Alex.
All right, Amy Morris, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. So head over to YouTube.com and search Bloomberg Podcast, and that's where you will find us. Let's check in with our next guest here, because what a lot of folks are trying to do is figure out how to reposition their investment outlook, their portfolio for a second term of President-elect Trump. Any changes that need to be made? People are trying to think about those right now. Peter Anderson is one of those folks, founder and chief investment officer for Anderson Capital Management, joining us from Boston, Mass. Via Zoom. So, Peter, we're almost a month removed from the election. We now have a Republican White House and a Republican Senate and Congress, by thin margins, yes, but still there. Given that backdrop, have you and your team made any changes to your outlook for investing?
Normally, this would be kind of a textbook exercise, but with the nature of President Trump, it's very, very difficult to make any kind of projections. And, you know, he's thrown several monkey wrenches into the works now. There's certainly the tariff situation has everybody running and scrambling to analyze how this is going to work out. So I would say the past playbooks, you really have to throw them out, and you have to look at something totally different, which is the dynamics of tariffs. How is that going to influence potentially higher interest rates? Items like that. So we are looking, but I will tell you, it's almost a fool's errand to try to work through all that and come out on the other end of that analysis with a highly confident outlook based on what the president is going to do.
So, all right, there's a high level of uncertainty out there. We've heard that from a lot of market participants as well. Given that, where are you guys today? Stocks, bonds, value, growth? How do you position right now?
Well, I just run a single strategy, and it's a growth strategy, equities. It's an all-cap strategy. So what we're doing is we're looking at the current holdings, and we're asking ourselves, how vulnerable are they to policy changes? And if there are stocks, in our opinion, that are more vulnerable to the uncertainties of those policy changes, we would probably look at selling. However, we've reviewed the entire portfolio, and in our opinion, all these stocks that we hold, which are under 15, in fact, are fairly invulnerable to tariffs, to interest rate changes, things of that matter.
How much of that is going to be, say, AI and big cap tech?
A lot of big cap tech. Also, I was a big enthusiast of artificial intelligence, namely NVIDIA and Supermicro and some of the others. But we're thinking now that the enthusiasm is a little bit overspent, and anticipations of how much AI is going to actually accomplish and contribute to the bottom line, we think is vastly exaggerated. And so we have trimmed those exposures dramatically coming into the next year.
Peter, how many stocks do you own in your portfolio today, roughly? And is that in line or a little bit different than past strategies?
Well, actually, exactly 13 stocks.
Wow.
So it's fairly concentrated. I don't think you'll find another manager out there that runs a concentrated portfolio of that few numbers of stocks. So you can imagine that it takes great confidence in the holdings and understanding each one. And certainly now with the change in administration, it actually puts more of an emphasis on that and to try to play out what we think is going to happen. So for instance, you mentioned artificial intelligence, but cybersecurity is a major exposure in the portfolio. And we think that regardless of who is in the administration or where interest rates are going, or if we have 100% tariffs, as have been mentioned recently in certain countries, we don't think cybersecurity would be impacted by that. It just makes common sense to us.
13 stocks. What's your average holding period? I would think once a stock gets in your portfolio, it's not going anywhere.
That is true. You know, the turnover is under 30% averaging over the past 10 years. And we really do spend a great deal of time looking at these stocks. And, you know, we sometimes get criticism, well, you know, it's so concentrated. What about your competitors? Your competitors own anywhere from, let's say, 50 to 100 stocks. And we challenge them on understanding those holdings in as much detail as, say, a portfolio of under 20 stocks.
So when you talk about the AI trade, like when you said that you think that it's an over-promising, well, I'm paraphrasing here, but the expectations are just too high. What do you mean by that? Is it just that it's not going to be this big revolutionary thing, or that money eventually will stop being spent on it? Can you dissect that a little bit more for me?
Of course, and thank you for asking, because I really do think this is a neglected point that investors really have to spend some time on. So I think investors have gotten a little bit over their skis in thinking that AI is going to be the cure-all of everything. And one thing I can just mention to you is if they think that it's going to emulate human thought, the brain is about the size of 2 fists. Look at the real estate of ChatGPT, for instance. I mean, it's enormous. And now we're thinking of dedicating nuclear power plants to powering these things when the human brain works on a refrigerator light bulb wattage, you know, under 10 watts. So we're going down the wrong path, we think, in terms of formulating artificial intelligence and making it human-like. We think that that's at least 10 or 15 Nobel Prizes away, and investors have not caught on to that concept yet, nor have certain CEOs. They continue to spend enormous amounts of money, and when you ask them what the rationale is, they say, well, because our competitors are spending just as much money.
All right, Peter, thank you so much for joining us. Always a pleasure chatting with you. Peter Anderson, he's a founder and chief investment officer of Anderson Capital Management up there in the Boston area. Talk about politics, trade policy. U.S. tightens curbs on China's access to AI memory and chips tools. Another widely read story on the Bloomberg terminal. Mackenzie Hawkins joins us, technology reporter for Bloomberg News. So, Mackenzie, just another, I guess, you know, salvo, if you will, in this technology trade war between the United States and China. Talk to us about this, the U.S. move here on chips coming out of China.
So this is what's now the 3rd annual update to these sweeping restrictions that the Biden administration has imposed on semiconductors and chip manufacturing tools being sold to China. So we started in 2022 with restrictions on chips that serve as the brains of devices, known as logic chips, as well as some semiconductor gear. The U.S. tightened those restrictions last year, and now we have a new set of curbs on high bandwidth memory chips, which handle data storage and are an essential AI component, as well as additional restrictions on semiconductor manufacturing tools. So expanding the list of tools that are covered and expanding the scope of restrictions to cover U.S. firms' manufacturing facilities that are located overseas.
So what was the problem, like with the original, say, curbs? Is it just keep expanding because the products expand, or was China finding a way around them?
So this is an incredibly fast-moving technology area. Chip tech accelerates by a generation about every 2 years. So the intent was always to continue updating and tweaking these controls as the technology progresses. But the U.S. has also been trying to close gaps in the controls that have allowed China to continue getting some Western semiconductor technology, particularly from allied countries such as Japan and the Netherlands, which are home to some of the most important companies in the chip supply chain. Those governments have agreed to some controls, matching some earlier U.S. measures, but they haven't agreed to the full scope of restrictions that Washington wants. And they are exempted from the latest expansion of restrictions on tool companies. There's also additional parts of these rules unveiled today that sanction 140 Chinese companies, mostly companies that manufacture semiconductor manufacturing equipment, so the tools that are used to make the chips, as well as a couple of facilities that manufacture the chips themselves in China. But the Biden administration stopped short of sanctions on a couple of key Chinese firms that they had earlier considered after intense lobbying from American industry.
Is there any evidence that these curbs on China's ability to get some of these chips, is it working?
So Huawei, which is kind of the center of China's tech industry, took a significant hit when the early curbs came out, and their ambitions to create ever more advanced chips have sort of been stalled at the 7-nanometer level. Nanometers refers to the kind of billionths of a meter, the length of a transistor that kind of powers a chip, serves as an on-off switch for the electronic signals. So that's kind of a standard for how we measure how advanced a chip is, and Huawei is trying to get to 5-nanometer technology, maybe even 3-nanometer technology, but they're sort of stuck at the most advanced chips that they can make with older generation tools. So cutting them off from the most advanced chip manufacturing equipment has put a significant dent in their ambitions. But they've invested in and partnered with this vast network of Chinese companies that are working on indigenously made semiconductor equipment, as well as chips that are more advanced than Washington hoped they would be able to make with the restrictions that they put in place 2 years ago. So it's kind of always a tit for tat. It's unambiguous that they've taken some hit, but probably not as much as the Biden administration would have wanted to see by now.
I love how you rattle off like what a nanometer is, as if like obviously everybody knows it's this thing where you measure the stuff. Do we expect the incoming administration to also sort of support all of these? Is this one area where Trump and Biden kind of agree?
So the initial restrictions on certain chip tools and the sanctioning of Huawei actually happened under the Trump administration. So there's good reason to think that directionally we'll be headed the same way that we're going right now. The question is how hard Trump will pressure U.S. allies that have not yet agreed to everything that Washington wants. And also there are some wild cards on China in his administration, notably Elon Musk as a key advisor. So we'll see what happens. Trump is known to be somewhat unpredictable and transactional in his foreign policy, but I think that this is one of the areas where we might expect to see less daylight between the Biden and Trump administrations than some other areas of foreign policy.
All right, great stuff, Mackenzie. Thanks very much, Mackenzie Hawkins, joining us, Bloomberg technology reporter, joining us on her great piece about the U.S. tightening curbs on China's access to AI memory and chip tools. Definitely check it out on the Bloomberg terminal. All right, coming up, because it's Monday, this is what we do. We do Bloomberg New Energy Finance. That was the old name, Bloomberg BNEF. We're going to be joined by Enrique Gonzalez. Talk about gas. Winter gas demand is really key. What happens to gas under President Trump? It's going to be a huge push to export as much LNG as possible, and where the demand actually will be. We'll break all of that down right after this. This is Bloomberg Intelligence.